1. Mic test. Mic test 2 5. Mic test 2 5.
Good morning, everyone. It's 10:07. Welcome. We'll call the meeting to order. Thank you all for being here today. I know these are always seem like marathon meetings at the end of the year, and we're going to have one today, but that's okay. That's good. We will start with our opening prayer, and then we'll do the pledge. Angela?
Good morning, everyone. Good morning. Let us pray. Gracious God, we come together grateful for the opportunity to gather in unity. We thank you for the blessings of this day and the purpose of this meeting. Grant us the wisdom to discern, the humility to accept, and the strength to follow the path you have set before us. May your light shine upon our discussions, and may our decisions always align to honor you and the communities we serve. Amen.
To the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Now, I'll do my best to follow this agenda. So I know that item 3 is, are there any citizens wishing to address the board today? And seeing none, we'll move to approval of the minutes. This is for the November 14th Joint Board of Managers and Finance Planning Investment Committee meeting.
Mr. Chair, I did have one suggested change to the minutes. I noticed that I'm shown as being both present and absent, and while I am very good, I'm not that good. So I was in the bustling city of West Lafayette, Indiana during the last meeting, so I was not present.
That is an amazing talent, and so we will make that change. That motion is as noted. Is there a motion?
Move approval of the minutes.
Thank you, Dorothy. Second?
Second.
Any other changes, discussion? All in favor?
Aye.
Any opposed? Motion passes. Good deal. Well, thank you all. Happy holidays. I mean, has this year flown by, and as the month of December, I mean, it's a blink and you'll miss it. And I just want to take a few seconds just to reflect on the year that this system has had. It really has been a phenomenal year. New faces, an entire team, organization of excellence. I mean, just Joint Commission, all the good things can only be done by good people doing good work with a good mission. And my hat's off to each and every JPS employee from the top down and the bottom up, caring for our patients and caring for this community. It's so felt, and we appreciate each of you as the year ends. It's been a really good year for the system, and I'm optimistic as the future looks really bright. I know that some of us had an opportunity to tour the new PEC, the Psychiatric Emergency Center, last meeting, and those who were able could attend also this morning. And what an amazing facility to be. One of the first projects out of the ground, probably one of the most high-profile projects that we'll do, and what a testament to how JPS feels about mental and behavioral health, because that is whenever the news media gets in there before it opens to see it, people are gonna be floored. It is truly something amazing. We're gonna get to see next Wednesday morning the groundbreaking for the Medical Home Southwest Roy Brooks. And I can't wait. I haven't seen that. I've only seen the outside, and if the inside looks anything like the outside.
Ribbon cutting.
Ribbon cutting. What'd I say?
Groundbreaking.
Oh, groundbreaking, sorry. Yeah, the schedule's amazing. Good job. The ribbon cutting, but if that facility, a tenth of it looks as good as the outside, we have some flagship medical facilities for this hospital system, and the future of healthcare in Tarrant County looks really bright. So if that's the foundation that we use to build the new hospital towers and the rest of the projects that we have in the master facility plan, I am really excited about the future. So hats off to everybody. So thank you all. I'll turn it over to you, Dr. Duncan.
Thank you, Mr. Chair, and good morning. I guess it's morning, our board here. Thank you. As Mr. Fisher, our board chair, has said, as we approach this holiday season, I also find myself reflecting on the many reasons I'm grateful for our dedicated workforce and for the incredible work that we continue to do together here at JPS. This time of year, I think we all are take time to be grateful for just being here, and this year is no different. This time of year offers us a chance to pause, to appreciate our achievements, and celebrate the spirit of teamwork that makes our organization truly exceptional. It's Tim's reason. There we go. They were practicing, and we continue to get loud. I will move forward to celebrate Thanksgiving and kick off the holiday season. We were fortunate to host our annual turkey toss, and I would recommend that if any of you have not ever attended our turkey toss, and in fact, we will give you a turkey if you do attend it. Our employees really love this. I was told if I eliminate this, it could be the end of my career, believe it or not. So, but we did have our turkey toss event. We distributed over 6,900 turkeys, hams, or fruit baskets to our dedicated workforce. All leftover turkeys, hams, and fruit baskets were donated to the Presbyterian Night Shelter or the Tarrant Area Food Bank, so nothing went to waste. It is truly a joyful time, as you can see here, and gives us a sense of community, shows our sense of community. Also, last week, DCEO Magazine hosted its annual Excellence in Healthcare Awards. This ceremony recognizes outstanding leaders in healthcare innovation in the North Texas region. We were finalists in all of these categories. So again, JPS being recognized for the great work that goes on. Let's just see. Well, we can see here that we were nominated for achievement in community outreach with our partnership with Casa de Esperanza, outstanding medical real estate project with Thrive on Crawford. I was one of the finalists, achievement in wellness programs with our JPS and Live and Wellness program, outstanding healthcare collaboration with JPS Health Network and our here Fort Worth for sound care, and then outstanding healthcare practitioner for Dr. Alan Podowitz. And our finalists, we actually won in 2 of these categories, which was achievement in community outreach with our partnership with Casa de Esperanza, and then also outstanding medical real estate project, our Thrive on Crawford. So you can see up here, Daphne and Joy accepted those awards, but we had great representation from JPS. So again, being recognized out in the community. I do want to, as always, call attention to the reason that we're here, and it really is to care for the community and the patients who need us. And so at JPS, as we know, we have an outstanding and amazing oncology team that recently underwent a successful cancer reaccreditation survey by the American College of Surgeons. And so it is my hope that each of you find comfort in Julie's story, and that she serves as a reminder of the importance of prevention and early detection.
You're being led along by those that you begin to trust, that you know that they want to try to take care of you, they want to try to help you. And since you don't know what to do, find that comfort in their guidance. The cancer itself, I probably had it for years prior to 2019 when I finally got the diagnosis. I think I had missed a lot of key points, a lot of key signs to the cancer because I made up excuses for it, or had that mentality of, well, I don't have time to go to the doctor because I've got to work, I've got to pay my bills, I got to do this. So that's when they had diagnosed me with the stage 4 non-small cell cancer that had went metastatic. Oh, I didn't want to know the time frame, but I knew it was quick. My little brother got in touch with JPS and started the treatment. At that point, I just knew all I could do was just take it one day at a time, and that's how we had started the phrase sunshine and smiles.
It's a lot of days where it's so hard to put that smile on your face or be positive, but I know I've got to do it for her because it's going to lift her spirits.
The idea is not to get too content and give up, because you never know, like in my case, when something might come about, even on a chance, that could change the outcome. And that's, I think, what happened when Dr. Nara came out and said, well, you know, hey, we can try this immunotherapy.
She always had a step for us to take. And then when there wasn't one, she found one.
What immunotherapy does is it tries to enlist the patient's immune system and fight against cancer. Within a few months, we started noticing improvement in her breathing, in her scans, and I think I gave that immunotherapy for about a year and a half or so. Yeah, so, and by then the CT scans were completely clear.
That's what changed the course of her cancer. Dr. Nara, her knowledge, everything she did is the reason why she's here.
Her story inspires me to keep doing what I do. And usually nowadays when I see her for a 6-month visit, most of our chat is just social about life in general and you know, how she wants to contribute to the success for others and how she wants to give back.
Even though I was at my worst, I still had time to breathe. I had time to walk out in my backyard. I had time to plant flowers. I had time to do these things that I never had time for. You know, and I got to spend more time with my family, you know, in that sense. So it gave a lot to me. I don't think my struggle was near as long as what a lot of people had endured. And so I feel very grateful for what everybody has done for me.
So I will end by, we are exceptional. I do want to take this time, because I believe this is our last board meeting of this year. I would be remiss not to thank you, the board, for your encouragement, for your support. We could not do what we did, and there was a lot of work that went on last year, but we truly could not have done what we did without your support and without your encouragement. So I personally thank you, but I would also say that the over 7,000 employees that come here every day and show compassion and empathy for those who are asking for help will also thank you. So thank you, Mr. Chairman. That ends my report.
Thank you, Dr. Duncan. And I echo those sentiments. This board is a great board, and my favorite part about it is that we don't always agree, but we all agree on the end goal. And getting there may have some disagreement, but the end goal is always been our patients, and I think that's great. So thank you very much. We will move on now to a report from the medical executive staff. Dr. Casey.
Thank you, Mr. Chairman. We have 2 items for approval this month, our routine credentialing activities for the month of December, and then 2 delineation of privilege forms in cardiovascular medicine.
Okay, great. The medical staff appointments are in your red folder. I'll give everybody just a second if they need it. When you're ready, I'll accept a motion.
Move approval.
Got a motion to approve and a second. Any further discussion? All in favor of the medical staff appointment and privileges?
Aye.
Any opposed? Motion passes. Thank you. All right, you want to talk about, do we have the privilege forms here? Is any discussion on those items?
And Mr. Chairman, just a quick update.
Sure.
For the TAVR program that we brought to the board several months ago, heart valve replacement, this is the privileging to allow that to happen, and we're actually anticipating first case going sometime next month.
Oh, okay.
So just keep the board updated. This thing is moving, progressing well,
Okay.
and this will allow it to happen.
Very good. We'll take these individually. Cardiothoracic surgery, delineation of privileges.
I did have a question.
Sure.
I noticed that for the surgery privilege list, it's got the TAVR listed as an addition. And then for the medical privilege list, it had the TAVR and the Watchman device. Should the Watchman be under surgery too, or just medical?
No, so TAVR requires both the cardiothoracic surgeon and the interventional cardiologist to be available and privileged for the procedures. Watchman only requires the electrophysiologist within cardiology, interventional cardiology. There's no cardiac surgery backup for Watchman.
Okay, but the TAVR's on both lists?
Correct.
Okay. That was my question.
Thank you, Blake. Any other questions?
My only question, just on page 14 of our materials, that looked like, and maybe I've just missed it before, that looked like a new page to me. And as a non-medical person, I was just going to say thank you for kind of summarizing what this is. That was really helpful to review this. So if we can do more of that or see more of that, that's really helpful. Thank you.
Okay, I'll ask for a motion for the cardiothoracic surgery privilege, delineation of privilege form.
Move approval.
Got a motion
Second.
and a second. Any further discussion? All in favor?
Aye.
Aye.
Any opposed? Motion passes. Thank you. Cardiovascular medicine privilege, delineation of privileges.
Move approval.
Got a motion and a second. Any further discussion? All in favor?
Aye.
Motion passes. Thank you very much. We'll move to committee reports and action. Up first, our matriarch, Ms. DeBose.
Thank you. The HR committee met November the 21st, and it was a kind of full meeting because they highlighted the accomplishments of our employees. That crew is celebrating and recognizing employees. And just like the other committees, we look for outstanding work that the employees have done. And there were 3 of our employees were off, and they in turn were in the right place at the right time and saved the life of a local musician, Tommy Lukes. And then behavior health staff were recognized. We got an update on the employee engagement, which we'd already had, and went through those things. Part of that was that Jill went through an annual incentive plan for 2025. I think that's right. We reviewed the results of this year, and then we looked at the annual incentive plans for 2025. And so we had a policy that was approved, and I have one item for closed session. That ends my report.
Great, thank you. And that AIP for 2025 is in our consent agenda, I believe.
Yes.
Okay, great. Thank you. Governance Committee, December 5th. Blake, you're up, buddy.
I am, and DT sends his regards. The Governance Committee met on December the 5th, and Colin presented updates on the governance annual audit plan and the Department of Justice's compliance guidance, and then Will discussed information security, and then we discussed a proposed Texas Responsible AI Governance Act, which has not been voted on yet, and Daphne discussed enterprise risk management. The governance annual audit plan is on the consent agenda today, and Colin presented that. That's for fiscal year 25. And the goals of that plan are to provide clear objectives and prioritize risks so that we can allocate our resources efficiently and look for constant, continuous compliance improvement at JPS. And the plan focuses on those risks that have the highest impact and the greatest likelihood. And so that would be the quadrant that it will focus most of its resources towards. And all compliance and audit work at JPS is data-driven and quantified. Colin then discussed the DOJ's 2024 compliance guidance update, which is sort of a path that they encourage you to follow. And one of their focuses, interestingly, in the year ahead is AI governance. They want to make sure that we're monitoring any use of AI for legal and ethical compliance. Will presented the Information Security Program assessment, which was conducted by Clearwater in July last year, following the NIST cybersecurity framework. And we also discussed that JPS is transitioning to the Azure cloud strategy, which means putting data on the cloud. And the benefits are security, cloud-ready tools, and another goal is for robust governance of what Will calls department-based technology, but that's also known as shadow IT, which would be little pockets of IT around JPS that are not part of the overall plan. And so this Azure cloud strategy will improve the governance of that department-based technology. We then discussed the AI Governance Act that's been proposed and that will probably come before the legislature next spring. And some of the goals of that act are to mandate unbiased AI systems and have stricter oversight for high-risk applications. And then we would do semi-annual compliance reviews and inform patients anytime that AI might be influencing their care. And of course, like with any bill, there's penalties for non-compliance. But this is just a bill right now. It's not law in Texas yet. Daphne then presented the enterprise risk management assessment. Senior staff was surveyed with a 68% response rate. And one of the things that was identified as a top priority is workplace violence. And then the risk management will collaborate with business owners to develop actionable plans going forward. There are two proposed items on the consent agenda. One is the governance work plan, and then one was an item that the board kicked back to governance, which is LD 1000. That was the orientation for us, for board of managers, senior management, and leaders of the organized medical staff, and the governance committee proposed that be archived, which means sort of shelved, because it's no longer needed, as that's part of the overall new compliance policy at JPS, that LD 1000 is no longer needed. So that will be on consent today. Questions?
No, I think we're good.
So when you mean it's going to be archived, so we're voting to archive it today?
Yeah, if it's on consent. If you approve the consent agenda, then that would be archiving the LD 1000.
Okay. I wasn't clear if it was we're approving it or we're archiving it.
Yeah, it's being archived or shelved.
Okay, perfect.
Removed.
That was the lawyer part of Margaret's brain.
You have two parts.
Approving the archive.
Yeah, approving the archive. Great, thank you for that. Compliance and governance has come a long way in a pretty short time, so my hat's off to you, Colin, and your team. You do a good job for us, and the governance committee is very important, and we appreciate your work there. Thank you, Blake. We'll move on now to reports, updates not requiring board action. Let's talk about the master facility plan.
Page number for, sorry.
You're on 41 of 241.
40, thank you. I'm back at the agenda.
Right, good morning. We're here to give our monthly update on the master facility program. And so Cam, if you want to lead us out, and Ramon, fill in any gaps for us.
All right, thank you, ma'am. Good morning, my name is Cameron Gertzma, Broadus Levis, and thank you for the opportunity once again to brief you all on the JPS master facility program. As you see from the slides here, I'm going to talk a little bit about some projects that are under design, but I'll hold off on some of the ones because we have some dashboards to brief. So temp parking continues to run through the audit and will be closed out by the end of the year. For medical outpatient building, it's in programming and design, and we continue to focus on finalizing the program and the budget. We expect final KPUs next week, which will finalize the optimization of healthcare services for the future and allow us to move into full design. So we're scheduled to conduct design in this coming year as we come out, starting in January, February timeframe for the MOB. For the CUP, similar to the MOB, we continue to focus on finalizing that budget and program, and we've aligned this project closely with the hospital, and we'll be looking closely to coordinate those efforts between the CMARs, which is Austin Commercial for the hospital, J.E. Dunn for the CUP, to ensure program requirements are being met. And additionally, the CUP design is underway, but will in earnest as well as the MOB commence in the coming year. And when I say the coming year, as we turn into January, February timeframe. For the hospital, the final concept design meeting was held this past week. The AE firm Beck with Hafer Welker is finalizing the product. For that concept design is expected to provide kickoff of the full design in January. Next week, we'll be briefing executives on the results of all that effort that has taken place in the last few months. And so then we'll be able to move into schematic design. And as stated last month, efforts are underway this month with JPS Contracting, Legal, and PDC with Broadus Levis Counsel on finalizing critical team contracts and associated agreements with the program. So as we come out of this new year, those contracts, those agreements, the team will be established that will allow us to not only continue with construction of the active projects, which I'll speak to here in a minute, but certainly with the gem and the pearl of the program, which is the hospital and supporting facilities for future patient care. You can go to the next slide, please.
Question.
Yes, sir.
Can you talk to me about the different types of design? You said schematic design and concept.
Right, so concept allowed us to take what programming efforts we had for the hospital and really refine what we were looking at for a podium, which is a superstructure, and going with 2 towers, what's the elevation, and kind of looking at kind of the Lego pieces, if you will, of the departments and the divisions that'll be associated with each tower and where they're located for operations.
Okay.
And so that's schematic design. That will really start to shape that out. And then from schematic design, we move into DD design development, which will then kind of get into the details of electrical, mechanical, civil engineering specific details. But coming out of schematic, we'll have a really good idea of what you're going to see for the hospital. And that'll run, we'll start that in January, and that'll run sometime through the middle of the summer.
Okay. All right, thank you.
Yes, sir.
The only thing I'll add is schematic design will also bring in a lot of our team members. So concept is really more broad and kind of big picture. How many lanes are we going to have, coming into the front of the hospital? What is the front of the hospital is going to be? Where is it going to be? Where is it going to be located? And so really high level, schematic design will be really bringing in the users of the spaces in the rooms, as we are, finished programming, but really what those spaces will look like. And so that is what we'll see this coming year.
Okay, thank you.
Roger, can I ask a question? Sure. Jill Cameron, thank you for being here today.
Yes, sir.
As we move through conceptual design on the new hospital towers, can we bring progress reports to finance and planning as you trace through that? Because one of the things, I think it's important, A, that we understand conceptually where we're headed, but I think also understanding what value engineering efforts are being made and alternatives within those value engineering efforts.
Yes.
Because a lot of that really are going to be policy decisions by the board. And what I don't want you guys to do is get so far out there on the limb, and then everybody here says, hey, wait a minute, we're not sure we're on board with that. Some iterative schedule of reporting relative to design to give us the ability to give input and hear feedback, because it's a lot of money, $300 billion. More than what we thought. So I think we need to be engaged with it. We need to understand it. We need to understand the options and be able to, at least from a policy perspective, look at those options and make sure that we're staying on the same page with you. Is that good?
little clarity on kind of an example for.
In summary, agendize certain milestones in design. Identify those milestones, bring those to us so that we can understand where there's been value engineering efforts and where those value engineering efforts may cross over into service impact. That's the key, is we need to understand. I mean, we may make some value engineering decisions, but unless we understand the impact of those decisions, we're not going to have any relationship with the policy outcome. So does that make sense?
Are you thinking a dollar threshold, or how do you envision that?
Both.
Because I think it's a great idea.
I'm not thinking about a dollar threshold as the initiative, Tim. I'm thinking about design first in terms of what we're trying to accomplish, because within that design framework, there's going to be a lot of policy decisions that could be made relative to cost. And in some cases, if we have the opportunity to save some money and there's not a gigantic policy impact on that, I want us to be able to look at that and see it. If there's not, we need to understand that too. So it's really both.
Good point.
Trent, I agree with you wholeheartedly, because I remember the last time we looked at design, it had changed dramatically, and I feel like we were not involved with that decision. So I agree with that. Thank you.
Yes, sir.
On 42, page 42, I think there's a bit of good news if I'm reading this correctly. Temporary parking is done. There was a savings there of $821,000. PEC, which we got to tour, and if you haven't seen some of these people in hard hats, you're not missing anything. But there's a savings there of about 1.5, it looks like. Are construction conditions getting more favorable, do we think, or are we just being that efficient with this money?
Efficient with the money first.
And so do we think that's going to keep going as we go into these? I see the $362 million increase there on the hospital. Do we think it will be that much, or do we think that we'll be able to reduce that number a little bit?
So where we are right now is that I would say that I think it is going to be that much. I would say that what we're doing through the design, going back to what Mr. Perry said, was looking at those opportunities. So you go back to the services that need to be provided, couple that with the performance units and, the key performance units in the out years, and looking for how do we optimize that design. And that's basically where we are at the threshold of that right now.
Sure. And I get that that'll be dynamic, but I guess what I'm saying, maybe I'm just wishing it into existence, that maybe this will become more favorable to us. And we'll see. But I'm encouraged by those two numbers.
Yeah, we'll continue to wish it into existence. I'm not sure I'm as confident, but I will say, I will caution too, temporary parking's not closed out yet. I mean, we still have ongoing maintenance because that is a temporary lot. And I'll also say, the PEC, we're not done yet. And so until we're done and closed out, I just caution, it does look favorable, I do agree, but.
Well, and on what is done, I mean, the medical home is 2.3 over, but, so I get it. I just.
Yeah.
And I can give you from my perspective too, in construction, that 2026 and 27 are going to probably have some, I don't know if you would call it inflation, but there's a good chance we're not going to have enough people and materials to build everything that the Metroplex is planning to build.
Sure, that's right.
So just keep the market is going to be extremely hot.
Yeah. Back to Trent's point, and Tim, the bringing it quarterly or however they bring it help us to see if it's up or down. But I would agree, as construction cost is going to go up before it goes down. I want to on the new facility. I think it was Dorothy, Trent, I don't remember, but several of us board members with staff took some tours of facilities, other hospitals, and how they were designed and built new facilities. I don't know if you remember that or not. Yeah. It was before the bond. Yeah, we hit about 5 cities in kind of a day and a half, and I was wondering, is that something that's being done with the design group now?
Yeah, so we've toured. In fact, yesterday I was over at Justin Towers Yeah, we should really, yeah, that's a hotel. It's always something we can't do, but I'm just going to tell you that.
Fortune 500.
But you know what, we've toured some hospitals, and even Joy Parker and I toured a Dallas hospital last week, and I think what we've all figured out is hospitals are still hospitals. I mean, the entrances may look grand and they may all look different, but when you get back to the care spaces, we're essentially all the same. And so, our focus is going to be on our patients and our care team and how to function within that space when we get down to it. And so at the end of the day, they're all hospitals. But yes, we've already gone to several hospitals. We're actually going to Parkland after the beginning of the year, looking at what they did and really learning from them too. Like, what do you like, what you don't like? Because, you often learn once you start living in a new space, we wouldn't have done it this way. And so that's equally as important as the wins that they've had as well.
Yeah, because Parkland looked like it was a bad design. Dorothy and I both talked about that.
No.
All those facilities that you toured prior to the bond are all being remodeled.
Well, and Reverend, what I've seen is the leadership is doing that. They're finding the time outside of, their day job in healthcare to actually be engaged in the design process and understand what works and what doesn't. And what we've seen is that the willingness of other facilities, Cooks, Parkland, and the like, to share their successes and their failures. And so when the leadership does come back into, at least through what I saw through the concept design, their engagement was very proactive in trying to make sure that they get the right facility designed.
Yeah, and we do not have to go very far. Every hospital in this medical district has construction that's going on, expanding towers. I believe Cook is going to expand their cancer care footprint. So we don't have to go very far.
Yes, sir. So for the Medical Home Southwest, no change to the budget and still holding. The ribbon cutting, as you stated, was scheduled for next week, December 18th at 10 o'clock. This will include a ceremony and a tour of the facility. The invites have been sent out, and the final setup will be we're in the throes of that right now, and we'll have that established early next week in anticipation of that ribbon cutting. The facility continues to remain on track and will be open for patient care first quarter of 2025. And so we continue to work with the JPS execs, directors, and leadership and their activation team in supporting that effort.
Let me say
Yes, sir.
Say one thing, because I've been telling the community in my area where I live, everybody come to the ribbon cutting to see my medical home.
Here we go.
You're right. I was out yesterday and I was trying to get it to take a picture with me standing like this, and he wouldn't do it. But yeah, good. I was going to work on that. Okay. But the one thing I wanted to mention that I noticed, a couple of my neighbors said this. They think that the facility is connected to. Yeah, but then Levis said that there was going to be another sign that's going to, because I kept saying, no, they're not the same. They're not, so. But it was nice. They've cut the lots so it looks good now.
Yes, ma'am. So for the PEC, no change to the budget, and as you've seen via earlier the site visit and last month, this morning by JPS leaders and members, construction progress is positive, remains on schedule, and continues to proceed as scheduled. We'll deliver this facility this summer. We'll turn over the TSP interior and the connector, which is the addition renovation section joining the two buildings to JPS this spring. The PEC facility, with the PEC facility proper to complete and activate and go live midsummer. So no concerns or issues at this time with this project. The garage, as everyone can see, is going up like gangbusters. Progress has been exceptional with the contractor and the subs. No issues or concerns. And you can see the precast columns and the panels going in place and the building's taking shape. And that superstructure will continue through spring, probably March timeframe as we build that out. March of 2025. So to date, no delays or concerns, and we continue to work with the Women's Health Clinic for the garage retail section that will continue to support their future home and their build-out. And the parking garage, as stated in the past, 2,500 stalls, which I know everyone's eagerly awaiting, and that's scheduled to be open in late spring of 2026. So pending any questions, that's all I have for the dashboard update. And I will get with Jill, Mr. Perry, on that quarterly. Thanks, ma'am.
Okay, any other questions? Thank you all for that update. So it's very good. All right, next we'll have the year-end investment report.
Managing Director and Portfolio Manager with Hilltop Securities Asset Management. The authority's investment advisor. I'm going to go through a couple of sort of distinct parts of this slide deck here today. The first section is a review of the investment report and the investment performance for the year ended September 30, 2024. And then I'll touch on the economic and the interest rate outlook as well. I will caution you, there are a whole bunch of slides in this deck, but I will also tell you I don't intend to go through each of them in any detail. So there's a lot of information there available to you. I recognize you have a very full agenda today, so I will fly through the second half of this at lightning speed. We'll start out by looking at the portfolio. This table compares September 30, 2023 with September 30, 2024. That is broken down by the major fund categories. The first one listed there is your 2023 bond issue in the construction fund there. The construction fund declined by about $57 million during the period, as some of those expenses have begun to come through. The other funds largely grew. In fact, as a total, the portfolio size increased by about $335 million during the year. So substantial growth in the portfolio. Some of that comes from interest income. We actually earned $102 million in income in the portfolio this year, which is a significant increase from the prior year. 2023 was about $65 million. Now, we, of course, we're in a much higher interest rate environment to begin with, but it also didn't hurt that you had over $400 million worth of bond funds come into the portfolio and had a full year of earning in 2024 and only about a half of a year of earning in 2023. Those are a couple of the big highlights. The weighted average yield on the portfolio increased just slightly from 4.7% to 4.73%. However, during the period, it did rise to as high as 490 before easing back down towards the end of the period here. It's important to note the bond proceeds from the construction funds, those were largely invested at the time that they were received in about April of 2023. And so the goal with those funds essentially was to lock in a yield that meets or exceeds what is known as the arbitrage yield. Essentially, this is the cost of your bond issues. So our goal is to recover or earn in income what you're paying in interest on those bonds while the proceeds are in our hands. There are a lot of rules and regulations surrounding that. The arbitrage yield on those bonds is about a 4.2%. They're currently earning about 4.5%. So we're comfortably above that ARB yield. That difference actually becomes a liability in income that gets rebated back to the federal government. So those are some earnings that you won't get to hold on to. Through the period ended September 30, 2024, that liability stands at about $2.5 million. So of the income that's been earned in the bond proceeds, about $2.5 million of that will go back to the federal government. Moving on here, this portfolio summary is just a snapshot, sort of some of the highlights of the portfolio during the period. I've already covered a number of these, the growth in the portfolio, the income, the weighted average yield. I will mention the transaction summary table at the bottom right. We had a pretty active period during the year. A total of about $1.6 billion in new investments was made, a total of around 85 new investments. We did have maturing investments, about 70 of those, about 1.4 billion. So again, with the portfolio growth, we're investing more new money than what we're getting from maturing proceeds. So the portfolio did have a fair amount of rollover during the period. I'd also like to spend just a moment, if I could, talking about the average maturity of the portfolio, and I'm going to back up to this page to cover that. So the average maturity of the portfolio, what is known as the days to final maturity or the weighted average maturity, this is a measure of how long it is before the portfolio rolls over and matures. So we're at about 279 days. That's roughly the same as it was at the end of the prior period. However, the composition of it has shifted pretty substantially. So the bond construction fund maturity went from 368 days down to 279 days or so. That, of course, is a passage of time relative to when the funds were invested, and you're beginning to spend some of those funds as well. Some of the other funds, primarily the future fund, we extended the average maturity of that fund. We also extended the average maturity of the malpractice self-insurance fund. So in the future fund, we went from about 300 days, roughly 10 months, to 561 days, about 19 months. What we're trying to do there is lock in yields that would have become relatively high levels. And so we did that through the period here. And we're now beginning to see that pay off as interest rates start to turn lower. So these funds then will maintain their higher level of earnings as market rates begin to decline. So that's an important shift in the portfolio. So even though the total weighted average maturity is about the same, some of the funds that you can go out into longer term investments, we have extended those out.
Greg, can you please explain the indenture agreements, which is the smallest fund you've got on
The indenture
slide
agreement,
50?
that's essentially your debt service payments. So your semi-annual debt service payments are made from those indenture agreements. And so those funds tend to stay very short and very liquid. They'll be available so that you're making those payments every 6 months, and so that those funds are available to make those payments. This next slide takes a look at the maturity distribution of the portfolio. About 72% is invested to mature within a year. The bulk of that, of course, is operating funds and then also your bond construction funds. The longer investments, roughly 28% of the portfolio, that's primarily the future fund and the malpractice self-insurance fund. But again, you can see here that it's distributed nicely across the periods, and that's really to, best we can to match up with the anticipated expenses. September 30 is a relative low point in the cycle. You get a lot of property tax revenues that come in the December, January timeframe. You spend those across the year, and as you approach September, October, November, your operating fund balances are getting a little bit smaller. We're also seeing some big moves with supplemental funding and other issues, and those are things that we work closely with the staff on to make sure that we're managing those flows as best we can. In terms of the top 10 holdings, largely held in U.S. Treasury obligations, and I'll cover a little bit more detail on that here on the next slide. So this looks at the asset allocation and compares where we're invested the prior year versus where we're invested today. The biggest change here really is the investments in agency securities, U.S. government agencies like the Federal Home Loan Bank, Fannie Mae, Freddie Mac. Those have actually been falling. We don't see as much value in those today. We're not seeing nearly as much issuance from those agencies, and there's not as much value there. So we've shifted the portfolio more into treasuries. It's about a 25% move out of agencies and into treasuries over the course of the year. We also increased our allocations a little bit into CDs. Again, bank CDs is another option that we utilize. We don't have a large holding in bank CDs. As of the end of this period, it's about 11% of the portfolio, and that's up about 5% from the prior year. Average credit quality of the portfolio, of course, the primary objective is safety of principal. So with 40% invested in treasuries and another 30% invested in agencies, well, we have a very high credit quality in the portfolio, generally in the highest rating category, AAA, AA, if you look at the technical ratings on the U.S. government. The short-term rating category, A1 plus, is the highest rating category available. That only applies to a very small percentage of holdings in the portfolio. I will note here there is one item here called SD. Those are what we refer to as secured deposits. These are deposits with banks, demand deposits, and certificates of deposit. Those are secured with pledged collateral. And then the final slide on the portfolio itself looks at the benchmark comparison. This compares the yield on the portfolio versus a number of benchmarks. The light gray line, unfortunately, at the bottom of this is the health system. So we have been lagging a little bit behind the benchmarks here. Part of that is because the rapid rise in interest rates during 21, 22, 23 portfolio didn't quite keep up. Part of that is also the bond proceeds, with a significant portion of the portfolio being invested there. We locked those in when they were invested in April of 2023, and so the yield on those hasn't climbed as quickly as market rates. But I will note that you can see here that really yields topped out earlier this year around April-May timeframe. And are beginning to turn lower. Now, I mentioned earlier that we had extended maturities in your portfolio, so we do expect that the yield on your portfolio should stabilize and not fall as quickly as some of these benchmarks. We're going to see the 6-month constant maturity treasury index and the Tchd overnight investment pool benchmarks. Those are going to fall pretty substantially here over the course of the next few months. The Federal Reserve began cutting interest rates in September. So far, they've cut 75 basis points. We're going to see another 25 basis point cut next week. So we do expect that the portfolio will look much better versus these benchmarks as we move into 2025. And I'll pause there. If there's any questions from that, I'm going to move on to the economy and the
One question,
outlook.
Greg. And I guess the question becomes whether it's S&P or Moody's. What is considered our minimum preferred rating by the rating agencies right now?
Well, basically, the portfolio is all in treasuries and agencies, and so it's either AA or AAA.
Okay. And so y'all's strategy relative to investment is that we always stay at least above that rating, right?
Yes, and you always will, just because of the nature of the portfolio.
So as we look forward, especially as future fund dollars are spent and less interest dollars are coming in, do we need to be conscious of anything relative to impact on rating from that change?
You won't have an impact on your rating from that change, because so much of the portfolio is invested in U.S. government and agency securities, essentially all of it. There's just a very small portion that's invested in commercial paper. Those are in the top rating category of commercial paper, which is the short-term rating here, so A1 or A1 plus. Those are essentially mandated by law. The Public Funds Investment Act in Texas greatly restricts what you're allowed to invest in, pretty much puts it in the top rating categories. So you will not have a credit rating impact on your portfolio, regardless of how it moves.
So then the follow-up question is, looking forward to the future issuances for the construction project, what are you anticipating those ratings to be on those sales? The same?
The same. You won't have an impact on the credit ratings because your credit ratings are dictated by your investment options, and your investment options are so limited, they're stuck in the credit ratings.
But we don't have to worry about our rating going down on future sales relative to our portfolio.
No, sir, but just let me clarify, make sure, because what I'm talking about here is the average rating on the investments that you hold.
And I'm talking about the interest rate on the bonds that we sell.
Yeah, and so I want to make sure that we're communicating clearly here. The rating that you receive on your bond issuance is independent from the rating on the portfolio of holdings, right?
I'm trying to make that transition, right? So as we look forward to future issuances, right, we've got a very stable investment rating and always have had. What I want to be conscious of and careful of is as we look at our interest rates that we pay on debt that we sell moving forward, we're going to see a much smaller balance on our cash. And I think we're going to be really conscious of what impact that may have on the overall rating of our debt moving forward.
Yeah, I would agree. And that will largely, the rating on your debt will largely be a function of your debt service coverage ratios. In other words, your ability to repay that debt.
Right.
And certainly in the planning process for issuing that debt, you'll need to look at your income streams, including your investment income. Right. And certainly that will factor into it as well.
Okay, thank you.
Sure. Any other questions on that portion?
Yeah, I've got a few questions here for you. So if I'm reading this correctly, as of September, our returns was about 4.73%. Is that correct?
Yes, sir.
Okay. What do we project that to be for next year?
I would expect that it will continue to decline.
Okay.
So right now, in fact, I'll get into, if you let's jump to the interest rate outlook portion, and I'll
Gotcha.
come back to that
Okay.
because I'm going to cover a fair amount of that in the next portion.
And I'll let you get to that next, and I didn't mean to jump ahead of you. So that 4.73%, is that net of Hilltop's fees?
Yes.
Okay, so that's netted out, that is what our assets are producing us.
And actually, I shouldn't say it that way because what we're looking at is not your return.
Mm-hmm.
It's actually the average interest rate that your portfolio was earning as of that period.
I see.
Okay.
And I see that we've got a pretty good large chunk of cash and CDs. Do we have any idea, is that primarily with one institution, or is that, who is that parked with?
So it's spread out, so this is your top holdings. So as you look at this report, Tchd is what is known as a local government investment pool. It's essentially a money market mutual fund. And so it's a short-term investment option. A good portion of your cash there, about 11% of your cash is held there with Tchd. You have some at East West Bank. You have some with Tex Pool, which is listed here at the bottom. That is another local government investment pool. So it is not all invested in one place. It is spread out a little bit.
Gotcha.
You don't have a significantly large cash holding. So if we look here at the bottom left table, and actually I should go to this other chart because it's a little easier to see, this top right chart. So the items listed there as bank deposits, about 1.3%, and then local government investment pools, about 12.6%. That's your cash holdings.
Got it.
So
Okay.
less than 15% of the portfolio.
Thank you.
Okay, well, I will jump to the economic and interest rate outlook. As I mentioned, I'm going to fly through this. So if there's questions or you want to interrupt me along the way, please feel free. A couple of things going on. First and foremost, the economy's been much more resilient than was expected at, say, this time a year ago. As I was sitting here a year ago, markets were expecting somewhere in the neighborhood of 2 to 250 basis points worth of reductions in overnight interest rates this year. So far, we've gotten 75. We'll finish the year with 100. So the rate environment has shifted a little bit as that expectation for rate cuts has faded away. And that's largely because both the economy has been more resilient and inflation has been more stubborn. Looking ahead, the election results have sort of shifted people's thinking once again. It looks like we're going to have likely slightly more pressure on inflation because we're expected to have a little bit stronger economy, a little bit more inflationary policies coming out of the new administration. That all remains to be seen. Of course, a lot of this is bluster and negotiating, so economists are anxious to see what actually happens and what the actual impact will be. And that's introduced a fair amount of uncertainty to the outlook. This chart shows the change in employment. So this is what we call non-farm payroll growth. This is through October. We just got the November data last week on Friday. October was depressed by the hurricanes and the strike during the month of October. November did rebound back, but importantly, and you can kind of see it here, job growth this year has slowed. So in the first 6 months of the year, the economy was adding a little over 200,000 jobs per month. Since July, we're adding about 150,000 jobs per month. So we do see some slowing in job growth, and that's reflective of a slightly softer labor market. That, of course, is by design. That's something the Fed was trying to negotiate as they were raising rates over the course of the last couple of years in a reaction to inflationary pressure. This is the unemployment rate. Again, market's still doing very well. Unemployment has risen only slightly. We're at actually through November now, we're at 4.2% on the unemployment rate. The underemployment rate, which is the red line, counts people who are working part-time but would rather work full-time or have given up the search for a job. And you can see there's some upward pressure there. But certainly with unemployment still below 5%, no real concerns about major job losses. This is known as the Job Openings and Labor Turnover Survey. It's a measure of the number of open positions advertised in the marketplace. And you can see back during the pandemic, over 12 million, and coming out of the pandemic, over 12 million jobs. At that time, there was about 2.1 open jobs for every officially unemployed person. That ratio is now back down to about 1.1 open jobs. So we've gotten much better balance in the labor force. And that is one of the reasons that the Fed has been able to begin cutting interest rates. They've softened the labor market a little bit. We'll take a look now at inflation readings. I mentioned inflation has been rather stubborn. This chart looks at the month-over-month changes in the Consumer Price Index. You can see here the last few months we've been about 0.2 or 0.3%, depending on the measure. The core reading excludes food and energy, so trying to take some of the volatility out of it. It's a little bit easier to see inflation if you consider it and think of it on a year-over-year trend. This chart breaks down the components feeding into inflation. And what you'll see here, we're well off the high. So Consumer Price Index peaked at 9.1% in 2022. We're down to about 2.6% on the all items or the headline index. So inflation has come way down. However, that red line is what we call core inflation. That's still running at about 3.3%. It's a little bit higher than we'd like to see. The Fed would like to see that somewhere in the 2 to 2.5% range. So we're not quite there on inflation yet. When I was here last year, Mr. Nguyen, and I'm sorry that he's not here today, asked me about inflation in medical care and in medical services. So this chart specifically looks at inflation in medical care services, which accounts for about 80% of the inflation in the medical side. Commodities or medical goods and equipment makes up the other 20%. You can see here this has been fairly volatile on a year-over-year basis over the course of the last few years. The 10-year average on medical care services is about 2.8%. Through October, we are running at 3.8% year over year. So medical care services inflation still running about 1% above its long-term average. Medical care goods, which I don't have pictured here on the other hand, is actually running about 1% below its long-term average of 10%, or excuse me, of 2%. And then finally, this is the Personal Consumption Expenditures Index. This is another inflation measure. It's actually the Fed's preferred inflation measure. They target this at 2%. The red line there, the core rate, is what you want to key on at 2.8%. Clearly, that's still above the Fed's target at 2%. But the big decline in inflation over the course of the last couple of years is what's allowed the Fed to begin sort of taking its foot off the brake and starting to reduce what they call reduced restraint, essentially allow greater economic growth. One thing I would caution folks on, we get this argument all the time, a lower rate of inflation does not mean lower prices. It just means the rate of increase is smaller. Yeah. And so those items that you bought a year or 5 years ago for $100, they still cost $120 today. They're not going back to $100. But we just hope that next year they're not $130. We hope that they're $122. So we're seeing a lower rate of inflation. And I'm going to skip over several of the next few slides. This is retail sales. Shows that consumers remain pretty resilient, still spending at a pretty rapid clip. This next chart is mortgage interest rates. Mortgage interest rates obviously have a big impact on housing, which is a large portion of the economy. The bottom in mortgage interest rates that we saw in 2021 resulted in significant activity, and a lot of us who were fortunate enough to lock in our mortgages at 3% or less are not getting rid of those mortgages, so we're not selling our homes. That's resulting in a much fewer homes being sold, so a lot fewer homes on the market available for sale. So we're seeing much less housing activity. The hope is that that would be made up for with new home sales. We're not really seeing that so much either. High prices and high mortgage rates are certainly a deterrent to people entering the home market. And so we haven't seen a huge rebound in new home sales either. Currently, there's estimated about a 3 to 5, and some people even say as many as 7 million unit shortage in homes in the United States. Now, one thing that we normally would see when we had interest rates go from 3% to 7% is a collapse in home prices. We haven't seen that. So this chart shows home prices. You can see here they're on an upward trajectory. They continue trending higher. In fact, just setting records again this summer. This next chart looks at the percent change in home prices year over year. Again, we don't see any big negatives here. Yes, new home prices a couple of times fell below that mark, very volatile, obviously. That, of course, is builders also reacting to higher costs and higher mortgage rates by building smaller homes and lower priced homes, trying to bring in buyers. But what we're not seeing is a collapse in home prices. And that's one of the reasons we're continuing to see inflation pressures, somewhat sticky inflationary pressures. I'm going to skip a couple of these slides. This is gross domestic product. This is kind of the scorecard for the economy. Economy continues to do quite well. Sitting here a year ago, there was a lot of economists that were forecasting very low growth, maybe 1% GDP this year, some even calling for a recession. We certainly haven't gotten that. The economy continues to grow at a 2.5% to 3% clip, and there doesn't seem to be any reason why that won't continue. This is a survey of economists from November. Their outlook calls for very moderate economic growth, slightly declining interest rates, and inflation heading back towards target. Nothing really too exciting here. I'm going to skip this graph. This is the Federal Reserve's so-called dot plot. It's very stale. A fresh one will be released next week. You guys can read the details here. And these other ones are sort of technical market indicators. I'm going to skip over those as well and jump to this slide. This shows us Fed funds futures. This is essentially expectations for the overnight target interest rate a year from now in December of 2025. In September, the expectation was we would see less than 3%, a 2.78% rate by the end of next year. Today, that's up to about 3.78, so just below 4%. So the expectation previously was that we would have at least 100 basis points worth of rate cuts next year. We're no longer looking at quite so many rate cuts next year. That has an impact on Treasury yields. This is the 2-year Treasury yield. The bottom came in September. We've rebounded a little bit here, of course, in the last couple of months. And really, I'm just going to skip right to the last slide. Don't have a whole lot else to add. There's a fair amount of uncertainty coming into the marketplace, as I mentioned. We do expect a few more rate cuts from the Federal Reserve, but we don't expect those to be steady. There's likely to be a cut here in December of 25 basis points. Markets and we still expect probably another 50 basis points of cuts next year. That's going to affect short-term overnight interest rates. And that'll likely be in the first half of the year. And then I think we're going to be sitting tight for a while. Now, further out the curve, if you look at 2- or 3-year Treasury yields, they always look ahead. They're always pricing in the future, anticipating. So we're starting to see some of those reactions in the market already. And I think I've rambled on long enough, so I will leave it there and happy to answer any questions if you have any.
Dustin, did you have any more questions? Or is everything clear?
No, I don't, but I mean, it's back to forecasting our next year's return on our assets.
Yeah, so we would expect that they will decline. Now, we very intentionally extended portions of the portfolio that we can, so that we can try to lock those interest rates and basically slow the rate of decline. But I think we should absolutely expect a decline in the rate environment. Your declining bond balances will also have an impact on the portfolio earnings. I would expect that earnings next year will be less than this year.
So that $100 million we made in income, interest income, would be what, projected next year? 70, 80 million?
I haven't really put the pen to it and done the math on it, but I would expect you're probably looking at something closer to 80 to 85 million.
And then not to mention the burn on cash as we ramp up all these projects. So
correct.
All right, thank you.
Greg, would a change in the tax-exempt nature of municipal bonds change your investment portfolio trajectory?
Generally, no, because we're investing in taxable instruments, not tax-exempt instruments. So that won't have a direct impact on us. However, it could change the market dynamics in terms of what other investors are doing, and that could have some impact. Certainly, it'll have an impact on your debt issuance.
Any other questions? Thank you very much.
All right, thank you.
All right, item 10, other matters considering board action and/or approval. Rory?
Do you need those? Make sure you study it. Yeah, what's that?
See a lot of long faces after that. See if we can change that course.
It was actually good news.
That's from my face. That's just my face.
Resting on.
Thank you, Greg. We appreciate everything Hilltop does. I think we can also expect to hear from the other side of Hilltop, which is of course, our issuance side of things in the next couple of months as well. For our bond issuance. So today we're going to briefly talk about our future fund. This is something we bring to the board annually. and we want to give you just a little bit of history for those that may be new. This is kind of a rundown on where the future fund has come from and where it has progressed to today. So as you can see there, we have done various things over the last several years to accumulate that future fund from both board designated repurposed funds as well as just operating cash. So we currently sit at $817 million on that future fund. And we've also, as you can see, earned just a little over 64 million on that future fund over that time that those funds have been invested.
So is that net of expenses? So we had $100 million. The $100 million we made in the portfolio now, is that what is represented by the 64 million net of what selling the debt cost us?
Yeah, it would be just what's on the balance sheet from our future fund, what we've contributed into the investments plus the earnings on it. So really, construction would be anything separate and apart from that.
Okay, so it's 64 million, and then the other, 35 million is just the money. Speaking about the 100 million that we made.
That is the 64 million on the future fund.
Right. The rest of it was made in other investments, not the future fund money.
This is over the life of the future fund as well. So there's a little bit of difference there, perhaps, in the way the numbers were presented. So what we are proposing today, we of course have a board designated policy to maintain 180 days cash on hand. So right now we would be sitting with operating cash of 246 days before our transfer this year. And then we would remain at 180 days after this proposed $303 million transfer into the future fund. Dr. Duncan and I did discuss this extensively about what the right strategy is, and really feel like it is a good opportunity for us to go ahead and boost that future fund given the construction needs and the targets there for the overall project. So this would put us relatively 200 million still needed for that remainder of the construction project. And so over 4 years, kind of projecting that's about 50 million a year. If you recall, we had been talking about roughly 85 million a year. That was before this year's contribution, so it's significantly improved since that original projection. So, questions?
Yeah, Rory, I have two questions. One, what's the date as of this slide here? What's this? As of what date did you have 1.136 billion in cash?
It would have been at the balance sheet, very recent. I don't know if it's November or October. I'd have to look.
But not September?
No.
And then second, what is the main reason or reasons why your cash position is better than when we're looking at it, during budget season, when we're looking at how much we're going to have to add every month, every year?
Well, couple things. When we looked at it at the 85 million mark for the future fund contributions needed annually, we obviously didn't have this year in that. But we've also got this year's results, 24, plus we also project out 25. So 25 projection plus what we were able to achieve in 24 makes the picture look just a little bit different. As you recall, during the budget, I went through some of the increases in the budget. The dish cuts were not upheld. That was roughly 80 million. And then we had about 77 million in net patient revenue, which was over budget. So all of those things kind of contributed to the more improved position. And for us to be able to make a little bit larger contribution than we normally do.
Rory, you mentioned that you and Dr. Duncan had to have a conversation about this. What would be the reason we wouldn't do this? What were y'all toying with?
Yeah, I think, good question, very good question. I think one potential opportunity might be to use some of those funds for other purposes that we might use for strategic growth. And I think we discussed we could always take some of that future fund and kind of repurpose it at the board's request. And And also, as you contribute to the future fund, you can see what the earnings are doing. So we would not want to forego any earnings on that if we can avoid that. So.
And if we delineate all this into the future fund, we can't use it for projects like that? We're not able to?
We would need to just have a board discussion and a resolution.
It'd be a policy.
Because if we're putting it in for future fund, we're saying we're earmarking it towards our construction.
I think the Futures Fund's original purpose was not just for construction. It was for other events, other things that we might need. It's just kind of, that's been our focus recently.
Yeah, and I think we see our highest risk being in funding that master facility plan. And so for that reason, we wanted to mitigate as much risk around that. But to Rory's point, it does give us opportunity if we do have new strategic initiatives to look at where we're currently at financially and possibly ask for board approval to redesignate some of that to some future strategic.
Historically, the future fund changed purpose whenever we came up with the bond package versus what the anticipated cost of facilities were. So there was $800 million that the voters approved. We always expected it to be $1.2 billion in that range. So the future fund became the default go-to mechanism. It was never really a board decision or a vote that says, okay, the future fund's now going to be this. It was just sort of a de facto position we were in. Here's the cash. We're going to have to keep saving it, and a lot of it's going to have to go toward facilities, but it's not a board policy necessarily.
Yeah, we knew at some point, whether it was new construction or significant capital improvements to the facility, that we needed to sock some money away, and that's kind of, and then it just morphed into what it is today. But, personally, I think this is a testament to this board and to Dr. Duncan, the staff, people saving and scraping. I mean, we've also delivered tax relief. Whether we thought that was the best policy or not, we're doing a lot of things still, and I think that this, being able to move this much money and be so very close to the ultimate goal of the 2.1, maybe 2.2, because I can't imagine it's going to cost exactly that, but to be that close to it, it should give our county commissioners, as well as all residents of Tarrant County, that we are fiscally responsible, fiscally sound, and we can deliver the promises that we made. So I'm really excited about that.
No, I want to reiterate that. I think this is awesome, and I agree with putting the money in the future fund, and just also want to reassure if we needed the money for something else, I think the board would be, I'm speaking on behalf of everybody, but I would hope that the board would be reasonable and being like, okay, we have a need and we might need to pull from there. But I agree with, we need to prioritize the facilities.
And I think in probably in the next year that there would be an opportunity that we would see the need to make a smart investment to help get us closer to the 2.1 billion, and having the ability to do that with board policy gives us a lot of flexibility to do that.
One policy assumption that we always have to keep in mind is that we have, by policy, designated that 180 days.
Right.
As a not to go below.
Sure. Well, and that's a bond covenant. We can't break that. So
I mean, and it's, well, I don't think it's a bond covenant necessarily. It's just a bond hedge.
Yeah.
I mean, it gives us the ability to make sure that we have those dollars available. But Margaret, to your point, I mean, that cash is there. And to the extent that we make policy decisions, that 180 days is also a policy decision. And a lot of institutions don't have the luxury of 180 days. A lot of institutions run on 90 days. Most cities run on 90 days, 120 days. So
that's what I was going to ask. I mean, how do we compare to other safety net hospitals? I mean, that 180 days is pretty significant. I mean, even our county's on a 60, 90 day.
Yeah.
Yeah, Chris Clark, our Forvis Mazar's partner, will go over those in just a bit. So great question.
But if we roll back to Trent's question earlier, this also supports when we get that cost and construction cost.
Sure. Did it increase?
Yeah.
Any other questions? We'll entertain a motion.
So moved.
Motion and a second. Reverend, I'll give you the second. I was looking that way and saw you say it, so we'll go there. I've got a motion and a second. Sorry, Blake, you'll get the next one. I've got a motion and a second. Any further discussion? We're going to move $303 million to the future fund. What an accomplishment. That's
great.
All in favor? Aye. Any opposed? Motion passes. Thank you, Rory.
You bet. I'll turn it over to Chris Clark and Kayla Marsh with our audit report.
Two financial reports, one meeting.
It's the finance.
Morning. Thanks for having us this year. We'll go ahead and get started. As Rory mentioned, my name is Chris Clark. I'm the managing partner of the DFW practice unit of Forest Mazars. Joining me today is Kayla Marsh, who you may recognize. Kayla was with me last year. She's a director in our office and has started to take on a greater role on this engagement. And I've asked her to give the bulk of this presentation, and I'll weigh in where appropriate. Here we go. So we'll touch on required communications, go through some key financial statement ratios, and then end with a couple of industry highlights. The first thing that I'd like to point out to you is that we are prepared to issue an unmodified opinion on the financial statements. We're in draft form today to give you an opportunity to hear the results and ask any questions that you might have. But we are complete with our audit procedures and are prepared to issue an unmodified opinion. That means that our firm is giving a reasonable level of assurance that the financial statements and footnotes are both accurate and complete. The accounting policies that JPS follows are consistent with GAAP and industry standards. We work with a number of county hospitals throughout the state of Texas, and as part of that, consider how your peer group are accounting for certain types of transactions that may be unique to the state of Texas, like supplemental funding programs. And what you do here is very consistent with your peer group, but your accounting policies and practices are outlined in footnote 1 to the financial statements. Annually, before we commence the audit and throughout the audit process and before we deliver the final reports, we evaluate our independence to ensure that our firm is independent from the organization that we're auditing based on AICPA independent standards, and can confirm to you that we've done those checks and believe that we are independent from your organization. I would like to commend Rory and his team in the finance department. Audits to complete them efficiently and effectively require good two-way communication and participation from the audit firm as well as the finance team, and your team here is prepared when we get started, engaged throughout the process, and collaborative, and we appreciate that. We had no difficulties that we encountered in conducting the audit, no contentious accounting issues or disagreements with your management team, so no issues to report to you in that regard. We're not aware of JPS having inquired of any other CPA firms about accounting or audit related matters, and we did not have to do that throughout the process either. Included in your materials is a draft of the audit report, as well as other material written communications, which includes our audit communication letters. These are items that are required by audit standards to be communicated to the governing board, and we've highlighted those here in these slides. There's also a management representation letter that Rory and Dr. Duncan signed, indicating that they also believe that the financial statements and footnotes are both accurate and complete, and that they have disclosed to us everything that we would need to know as it relates to the audit of JPS. I'd like to also highlight to you areas that we deem to be the most significant risk areas in the financial statement audit. As we begin the audit each year, we go through a risk assessment process to evaluate risk of material misstatement. Based on that risk assessment, we design audit procedures to address those risks. The most significant areas of emphasis for us this year are estimated amounts due to third-party payers. That includes all of the supplemental Medicaid funding, the allowance for doubtful accounts or uncollectible accounts accounts, on your patient accounts receivable, and then the assumptions that go into measuring the net pension liability on your defined benefit pension plan. So this is where, while we audit all aspects of your balance sheet and income statement, this is where we tend to spend a lot of the time, because if there is going to be a material error in the financial statements, this would likely be in one of these areas. And then I'd also like to report to you what we deem to be the most significant financial statement disclosures for the users of the financial statements, and that would include patient service revenue, the types of payers that you have and how that revenue is recognized, the supplemental Medicaid programs. As you know, those are very complex and change often, and so understanding the nature of those programs, what drives the reimbursement and how that reimbursement is recognized is important. And then lastly, the defined benefit pension plan, the nature of the benefits that are provided and the key assumptions that go into measuring that liability. I'm going to turn it over to Kayla now, who's going to touch on other results of the audit and go through some key ratios with you.
Awesome. Do I press the button? Everybody hears me?
You're good.
I'm good. Thank you. Morning. Thank you for having me today. So as part of the audit, the intent of looking is there any material errors in the financial statements that we identified as part of our procedures. This year, based upon our procedures, we did not identify any material adjustments that were required to be recorded, which is a great sign. So there were no recorded financial statement adjustments to the financials that are being presented today. What we do as part of our process, though, is that there are times we aggregate differences that are identified in the audit that are not so material that they're required to be recorded, but we do like to make the board and those aware of that. So as part of the board letter that you'll see, there's something called a past adjustment schedule, which is the differences that have been aggregated throughout the audit process that weren't material enough as determined by management to be recorded, but were larger than trivial and to be brought to your attention. And so as we look through those, the summary of the impact to your financial statements of those adjustments or differences that were identified that weren't recorded in the financial statements are listed here below. What I think would be important to note is the change in net position of about 3% as relation to those past adjustments. The vast majority of that was the turnaround impact of the past adjustments identified in the prior year. The only two past adjustments that we identified specific to the current year procedures this year were actually identified by management for information that came to light to the district in October. So management worked diligently. They brought that to us and said, hey, we have some differences that we think could be pushed back just based upon the information that became available. They worked through those. We agreed, but they said they're not material enough that we believe we should record them. So if we look alone at just the impact of the past adjustments identified in the current year by management that weren't recorded, that impact is 0.04% on change in net position. So I think that's a pretty good thing to see as well. Let's hit the right button. There we go. So we've put together a couple of slides that we'll run through that one looks at different KPIs for the hospital district here at JPS compared to a couple of additional safety net hospitals in the same relative peer range. We've summarized here the relevant metrics of those districts to give you an idea of size. As compared to JPS. So one of the things that we'll mention last year, pension funded status is something that districts like to talk about a lot and look into. In the prior year, on the right side in the bottom right corner there, you'll see that JPS was at about 86%, which was lower than many of the peers at that time. The impact of your pension funded status is really volatile. It's dependent upon the market. It's dependent upon actual experience. Actuarials come through and estimate what those numbers. And so you'll see that measurement date last year for a lot of them were at different dates, and JPS was the only one in September. Market fluctuates at different times of the year. This year, what you'll see is that now JPS is at an 88% funded status as compared to its peers that have kind of flipped. And so what I think this shows is that their funded status has remained strong. You close the plan, and it's still relatively consistent and not in any concern that if you saw it fluctuating drastically in a different way. So we've presented a 5-year schedule of the balance sheet for the district. One thing I will say, in the past few years, we've had some new standards that we've had to adopt, leases and another one called Sabitas. Luckily, this year in '24, there were no new accounting pronounces that had to be adopted. So it's a little bit more consistent to look year over year. Some of the things I would point out just as the change and has discussed previously this morning, you'll see growth as continued growth in cash, both from positive performance by the hospital. You'll see a slight decrease in your Medicaid receivable, which is related to your supplemental funding. That decrease from the previous years really was driven by the fact that this year your UC payment was received before year end. It doesn't mean anything about the program and the funding going forward, but just the timing of the collection of that cash also is increasing your cash as well. That was about $80 million or $70 million last year in the receivable. Of course, as we've spent a bit of time talking about this morning, about $135 million growth in your capital assets from the prior year as you continue to construct the facilities. There's some growth in accruals as things have become more expensive. Obviously, your expenses and your accruals are going to increase as well. And then also the reduction in debt, which would be just your standard principal payments on your debt coming to fruition.
Another highlight here, Kayla, I think, is just over that 5-year period, you can see that your total assets have doubled, as has your net position or your equity. So, general strengthening of the balance sheet over this 5-year period.
Absolutely.
Is that page on our
in the portal, in the packet?
Yes.
I don't believe so.
Gotcha.
So there is a 3-year presentation and a summarized version and the management discussion and analysis of the audit report, and then the actual financials in the audit. There are 2 years. But so as we've kind of spent a bit of time talking about cash and investments and what those components are and the way that they're presented in the financial statements in accordance with GAAP, we provided a summary here of how cash and investments is separated. So the way the financial statements require you to present them are they externally restricted? So are they unused bond proceeds that are earmarked specifically by the bond proceeds for capital improvements? The restricted cash there of $118 million is related to the LPPF that has to be utilized for IGTs in the future. And then your internally designated is those that the board here has decided to internally designate and earmark for its purposes, and what's remaining is your undesignated cash and investments. Numbers that Rory just showed were from a different date, so these differ just slightly, but this is where they were at year end. And then your net position to show the components of what all is in your net position. While the unrestricted number is about $1.8 million, $800 million, or $1.8 billion, $800 million of that has been internally designated and earmarked for future purposes. And the last sentences below there is just a footnote in your financial statements that further breaks that out for the users as they read them so they can identify that as well. So for the next few slides, we're going to go through some different KPIs. So first, most importantly, is on days cash on hand. There were a few questions there earlier. And what I would say here is, so JPS is the green line at the top. So you'll see that days cash on hand has continued to increase from the prior year to about 429 days. The districts are going to be in your red line. So that peer group that we showed previously, you'll see that the districts for the past 3 years have also increased in days cash on hand, and they're ending at about an average of 241 days from that peer group. Now, what I would say is that 241 is a blended average of 4 different peer groups. The range of that is anywhere from 25 days to about 375 days. So there is a large range there, and there are some at the upper end of days cash on hand. One other line that we presented as well, just as you look at it, is the blue line there in the middle. And what that represents is JPS's days cash on hand when you exclude the internally designated funds. So when you exclude those internally designated funds that you've reserved for capital and future purposes, you've got about 238 days cash on hand.
We have discharge material.
No, but we can distribute this slide deck.
Welcome.
The other thing that I might point out there, I mean, it's, each of these districts are different markets, obviously. Many have gone through expansions, so have utilized cash, cash and debt to finance those expansions, and have started to operate those expansions, which have had pressures on their cash balances. So I think at this stage in your life cycle, and as you embark on this building program, it's not unexpected that your overall days cash on hand, which is the green line, would be higher than your peer averages right now.
You would expect as we start to finish out these projects and start to operationalize them.
It's going to come back down. Right.
Correct.
And then Kayla mentioned too that there, you can see between 2022 and 2024 in that red line, the average has increased. So I think in general terms around the state, due largely to supplemental funding that has been concentrated towards organizations that take on a lion's share of uncompensated care, that has improved cash position for the major hospital districts overall in the state.
All right. So the next measurement that we're looking here is days in AR. What I think this shows, JPS is at the bottom of the graph, which is actually a good thing. It shows that your billing office is doing a good job of billing and collecting for the services you're providing quickly and not leaving too much cash out in the market to receive. So they're performing both better than market and the districts as well. We've talked a little bit about the pension plan funded status. Here is, in the red bar, you'll see is JPS. We've remained relatively consistent, maybe a little bit better than prior year, improvement to about 88% pension funded status, but you'll see relatively consistent with its peers and the industry as well. And then here, what I'd like to show, in the past, the talking point for this slide is JPS did not have to take out any debt to maintain its operations through up to 22. Whereas many of the peers did have significant debt on its balance sheet. In 2023, you'll see that's when the Series 23 bond funds came out, but compared to its peers, it's not making up a significant portion of their unrestricted cash. And you'll see that slight reduction is largely driven by the payoff of the debt in the current year. So next, we'll talk a little bit about some of the components of your income statement or your statement of revenues and expenses. I think, you see a healthy bottom line here up to about $336 million $36 million in 2024. I think the largest components of that you would see of swing is going to be your growth in your net patient service revenue, largely driven by both volumes and favorable payer mixes in 2024 compared to previous years. You will see some growth in your expenses with that as well, as wage rates have been increasing and also costs to address those increase in volumes. And then as discussed previously, there's a healthy growth in your investment performance as well that is running through that non-operating revenue and expense line down below. There we go. All right. This chart here is an indicator of, are you collecting the revenue that you're recognizing? These bars will never line up perfectly. The red bar is indicative of the cash you're receiving on patient collections. Blue is the revenue that you're recognizing in the financial statements. So as long as those two are fairly closely aligned, that's a good sign. You're concerned if there's big swings. You'll see this year that the red line's a little bit higher than the blue bar. What that is really indicative of timing of collection. So last year there was a large cost report settlement of about $20 million that was in revenue last year that was collected this year. And so that's why you got a little bit higher. Does not mean that the numbers were incorrectly stated in the prior year, but just a timing of cash collections. But seeing them consistent throughout these years is a good sign for the district. And so I will pass it off to Chris for a little bit.
Just have a few more slides for you. This chart compares your property tax support relative to the other districts. So the bar represents the total dollar value of tax proceeds. The percentage that you see above each bar represents the amount of support that tax revenue is to the overall revenues that come into your organization from operating revenue, so services from patients, supplemental funding, and other operating revenue and property tax revenue in total. As your rate has decreased over the last couple of years, that percentage has also decreased, and you can see you're at 29% for fiscal 24 as compared to 34% in fiscal 23. And then you can see the ratios for the other major districts as well. El Paso's really an outlier, so I would probably focus more in on the other four major markets in the state. And obviously there's variables in each of those markets in terms of payer mix, the overall uncompensated care burden, other sources of revenues that they have. But I think this suggests that you're right in line with your peers in terms of the support that's being driven from tax revenue. And this is all tax revenue, so tax revenue for maintenance and operations as well as debt service.
Chris, why is El Paso an outlier?
Well, they're much smaller, number one, and when Kayla mentioned the range of days cash on hand from 25 up to, 350 or 400. El Paso's that 25. So they have been operating for the last several years with a very low amount of cash on hand. And so I think that, and that's largely driven by the fact that they do have an uncompensated care burden that they have to deal with, but don't get support from tax revenue to really, balance that.
I guess that's what I'm saying. So I'm understanding this slide as it relates to tax revenue and property values. They're just getting income from other sources, probably the federal government, more likely, other places.
Yeah, well, not other sources. I mean, it's same sources, supplemental funding and patient revenue are the two primary sources. And so, yes, they are just getting less support from tax revenue, but what that has meant for them is that they find themselves in a cash position that's probably not sustainable long-term.
And this takes into account
Yes.
This would be the 24 tax rate impact. It does not factor in 20.
Does not.
Yep.
Correct.
Okay.
And we've mentioned supplemental funding a few times. I think it's important for the board to understand what this means to the organization. So this will show the total dollar value of the supplemental funding plus the support that represents for your organization. So 16% in 2024, much higher in Dallas and Harris counties just because of the volume of uninsured patients that they have in those markets. In San Antonio, they have a higher commercial payer mix than you do or the other two larger districts do. And there's, I think the hospitals in that market probably take on a little bit more higher share of the uncompensated care burden. And then this will show you the funding by program. There are 6 programs now that are represented in this graph, Africa being the latest. So the state continues to find ways to draw down all of the federal dollars that are available to the state of Texas, and that has been through the evolution of these different supplemental payment programs. So that's why you see those changes over the years. And then lastly, just to wrap up, I think you're all aware that the current waiver takes us through 2030. So I don't anticipate material changes in overall funding. I think we could see evolution in how that funding is allocated to the hospitals. That seems to be on an annual basis something that HHSC is evaluating as they try to create an equitable split of these dollars for hospitals throughout the state. One thing that impacted your revenue this year was the opioid settlement, which was $7.5 million for JPS this year. And then, I just mentioned kind of evolution of these programs and changes that could occur. In addition, you see pools and how those pools are allocated are constantly being evaluated. So if anything, I think you could probably envision some change that would be a decrease in DISH or and an increase in UC or vice versa. But I think it's important to always keep your eye on changes that are happening there, and I know your finance team here does that. The OIG continues to scrutinize our funding mechanisms here in the state of Texas, primarily through the LPPF. So I don't know where that's headed or when a resolution on that would be likely. I do know that the OIG is investigating that and could, if they blow up that model, could create chaos for the state in terms of how we draw down those federal dollars. And then obviously a big issue for the healthcare industry, as it is for all industries, is cybersecurity and data breaches. We continue to see clients who are facing that issue. So key thing here is to make sure you're appropriately insured and continue to evaluate risk in that area.
I think the last thing I started off saying, we had no new standards adopted in the current year. The county team was thankful to get a break last year, but in '25, there will be one more new standard that's being adopted with relation to the accrual for the way paid time off is taken, so PTO, vacation time. It is currently accrued, but the GASB has gone back and reevaluated what that looks like. the thought is that it might likely increase slightly. It's going to be largely an impact on your balance sheet more so than your income statement. We're working with management right now to identify what that looks like so you can get a clear picture before year end and before it's fully adopted. And we'll be working with the team over the next coming months to ensure that that number gets identified early.
Be happy to answer any questions that you all have.
Are y'all, I mean, I understand this is not the scope of what you were doing, but do y'all have an idea of how the new tax rate, the property tax rate, is going to impact some of this for us in fiscal year '25?
I think that'll largely depend on the valuations. So, you could have to make some assumptions on what those valuations look like, but I don't have a number in mind on that.
No, and I think what you could look at is that if you look at the trend for the 3 years, 3 years ago with property values, it does impact us. So you might have gotten 34% of your revenue from it with a higher tax rate, but it has different components that go into it that could change the dollar amount that it effectively ends up coming through the door.
I thought that we had made the commitment to keep our pension fund funded at 100%. And I know we showed here today we were somewhere around 90%. Can you help me with that?
I don't think you've committed to keep it funded at 100%. You have committed to make the contributions on an annual basis that are estimated by the actuary, 100% of those contributions. Okay. And there has been a year or two where additional contributions have been made to get that funded status higher. When you look at municipalities overall, I think the 88% funded status is pretty high relative to the industry.
That doesn't represent a contingent liability, that gap?
The gap does. So that difference between 100% and 88% is reflected on your balance sheet as a liability.
Okay. But not something that concerns you guys?
No, not at all.
Okay.
Chris, I had some questions.
Sure.
On pages 4 and 6 of your report, which in our board package are pages 96 and I guess 98, can you add a thousands label to those pages? I noticed it didn't say thousands.
Oh, sure.
Yes,
absolutely.
Absolutely.
At first, I thought we'd gotten a lot smaller, but I figured.
$5 billion.
Yes, by about 1,000. And then, do we account for our property taxes that we collect largely in December and January as unearned revenue throughout the year, and amortize it pretty much evenly throughout the year, a 12th each month, basically?
That's right. So when you get to the end of your fiscal year, the only thing that remains as a receivable is any delinquent taxes and the estimated collectible on those. And then on October 1st, you essentially record a receivable for the full amount of the tax levy, defer the revenue, and recognize that throughout the fiscal year.
Is there a liability, though, for the revenue we haven't earned? Because
that's the deferred revenue piece. So you would essentially recognize the receivable and then a liability for the deferred revenue component on October 1st of each fiscal year. At September 30th, there is no liability because all of that revenue has been earned.
Okay, I was wondering why there was no liability, say on page 4, just in that position page.
But yeah, because the way that the gap works on that is that you recognize tax revenue for the period for which it's levied. So your 2023 levy was designed to fund your 2024 operation. So you recognize that revenue throughout fiscal 24.
Not through the calendar year.
Not through the calendar
Even
year.
though it's as a property taxpayer, that is your calendar year obligation. There's a 3-month
That's correct.
offset. But we consider that to be fully amortized by September 30th, even though 3 months of that is still left in the calendar year.
Well, so the 2023 levy, which begins being paid in October 1st and that's the first month of fiscal 24. So the calendar 2023 levy funds fiscal 24 operations, and that's when you recognize that revenue. So by the time you get to the end of September of 2024, you've earned all all the revenue from the 2023 levy.
2023 would be the property tax that taxpayers pay in December of '23 and January of '24.
That's correct.
It's in arrears.
That's right.
They're paying in arrears.
Right.
And I would also note in your financial statements and the footnotes, footnote 4 for property tax revenues walks through the dates at which they're levied based upon the period at which they're measured upon and how that revenue is recognized based upon the levied period starting on October 1st that walks through those,
Okay.
the accounting treatment of those.
That can get really confusing.
Yeah.
For the audited financial statements on September 30th, our property tax liability would be zero.
That's correct.
Okay. And if it weren't zero, what would the descriptor be that we would see on our balance sheet?
Likely deferred revenue, and I think you probably see that in your internal financial statements right now.
As a current liability?
As a current liability.
Okay, thank you. And then just one comment for the board. If you look at page 6 of their audit report, which is page 98 of your board package, I just wanted to point out that property taxes are shown as a non-operating revenue, which is below the operating loss line, and we have, and I appreciate our doing this, we changed our internal reporting to match the audit report. We also now show our property taxes as a non-operating revenue and not an operating revenue. We used to put them at the top, and now we match what the auditors do, which is correct because property taxes are not healthcare revenues. They're a subsidy from the taxpayers. And then last comment on page 31 of your report that you gave us, which is page 123 of the board packet. And this may be too detailed a question because you may not be prepared for this, but there's a cash flow statement showing our bond payments, our debt service requirements. And again, that's page 123 of our board packet or page 31 of the audit report. Starting in 2030, you're showing 5 years at a time. And let me know if you need to get there, but you're showing 5 years at a time of debt repayments. It looks like if you divide those by 5, our debt payments are dropping starting in 2030 by a couple of million a year based on current debt, from around 29 million per year to 27 million. Am I reading that right?
They're actually accelerating. They grow to be larger payable amounts starting in 2030, in 2035 in that bucket. So they may be around $9 to $10 million for the first 5 years, and then that 23 bond, the bond payments get larger as you get further out.
I'm looking at, it's the chart on page, it says 31. It's 31 million and some change currently for fiscal year 25. And then in 28, it drops to 29 million.
Oh, yes. That is the other bonds are being paid off at that point. So by the time you work into those years of 2028, 2029, your other bonds that are outstanding would have been fully paid off. So right now, you're still making bond payments on Series 2016 and Series 2012. Those will become fully paid off in those years. So you'll no longer have that debt service, but what is remaining on a go-forward basis would just be the bond payments for the Series 2023 that you pulled down last year.
There's a further reduction in 2030 to about 27 point something million. It drops another 2 million a year. Is there another bond that's been paid off by 2030? And then it stays level for the next 15 years.
Yeah, to have to go back in detail, look at exactly what the individual component is, but I do know that the reason why you're seeing a slight reduction over time is largely due to the scheduled bond payments that you have outside of just the Series 2023, and then you will see at the end of Series 23, there is, at least in what's going to principal, I guess they are relatively consistent, what's going to interest versus principal, you're going to be paying off more.
Thank you.
Yeah.
Any other questions? Comments, concerns? It's a clean audit.
Yeah, I've got just one question for you. I'm sure it's in here, but under your assets, where's all of our real estate and all these improvements and these big capital projects?
Absolutely. Yeah, you're going to find that under capital assets net.
Okay, makes sense.
And then there's a footnote too that breaks that out by category.
Got it.
Yeah.
Thank you. And is there at any point that goodwill is to be considered with this operation?
No, goodwill would be indicative if you acquired a operating business or an operating entity from another company into which you pay cash greater than what the value of the assets and the fair value of the assets that you're acquiring. When you're constructing, those from the accounting standpoint is recorded at historical cost, which would be effectively what you pay for, and there's no cash there or no goodwill there.
Thank you.
Okay. Thank y'all for the presentation, and thank you for the audit, and thank the finance team once again for a clean audit. I'll ask for a motion to approve the external audit. Got a motion?
Second.
And a second? No, I'm going to give that one to Tim since you got the last one. Any questions? Further comments? All in favor? Any opposed? Motion passes. Thank you.
Thanks, Chris.
Okay, Rory, come back on up here. CFO update, consider approval of October 24th unaudited financial reports.
Just a quick thank you to Chris and Kayla and their team. And of course, many of you know Courtney Bodeker. She's our controller. She is very instrumental in that whole audit, and her team, Robin Suter and Clay Landry. So really want to give them a word of appreciation.
We're at page 150 on the portal, just FYI.
Yeah, so due to the heavy agenda today, I'm going to keep the October, we're all the way back in October for a financial report due to Joint Commission and due to just November. We are looking at October financials. November financials would not be ready at press time today. So that's why we're looking back as far as we are. You'll see a little bit of an extreme makeover on the format. You might ask why. Just really to eliminate some of the redundancy that we had in the packet, particularly around statistics, and then also just a much better looking presentation from what I would say about that. So that's why the changes are there. A couple of things about the packet. Tier 2 goals are still being finalized. Oh, thank you. Tier 2 goals are still being finalized, and then we also have some additional financial performance metrics that we're finalizing as well, so hope to see those in the next report out. So we dive straight to the income statement. I would direct you to your packet on your device because it's very hard to see on the screen, but I'll walk through some of the highlights around the income statement for October. Really, we had a little bit of a decline in net patient revenue of about $1 million, roughly 1.1 million. Our payer mix is just slightly unfavorable in commercial, as well as a little bit in just self-pay and unfunded. It has increased in the month of October comparatively to where we expected it. But we had a little bit of a makeup of that deficit in retail pharmacy. And then we came in very close in labor, actually favorable in labor, about 1.7 million. And then contract labor, on the other hand, was a little bit above budget where we expected. And then, of course, we have some purchase services, dollars below budget, as well as supplies. So overall, we did create operating income of 3.6 million. We did have a non-operating kind of major impact in the month of October around the investment portfolio. The best way I can describe it is Greg, if you looked at Greg's bottoming of the graph, when he looked at that interest rate, the previous 3 months we were increasing our fair market value, and then in October interest rates actually rose, so we took a little bit of a hit in that fair market value in our portfolio. So that explains that $6 million change in the month of October. I have been asked many times since the numbers have kind of been internally circulated is, do I expect this trend to continue? I think Greg's explanation of interest rates falling should make bonds, of course, at a stated interest rate worth more, so we should see a little bit of an improvement in our bonds, but then we might take a little bit of a hit in our cash due to the interest rate on CDs. So it's going to be a little bit volatile, but the month of November did stabilize. We did not see this large deficit in November. So those are the highlights on the income statement. I'll pause there. And
Roy, just a comment on the $6 million drop in the value of the investments. That sounds like a lot, but it's on a portfolio of over
$2 billion.
$2 billion, so it's a fraction of a percent. It's
0.28%.
Yeah, it's going to fluctuate back and forth every month.
Help me to understand.
It's fractional, Blake. Good point. Yeah, on $2 billion, it's 0.28%. Like I said, the 3 months prior, we picked up $15 million in fair market value, and we gave back $6 million. So I think what happened is it really crossed over into a new fiscal year where we weren't seeing the preceding months. So it looks much more magnified. Yeah. So, okay. All right, balance sheet, not a tremendous amount given the length of the agenda that I need to say about the balance sheet. We'll go into statistical highlights. I am on page 155 of your, of what shows to be page 155 of my packet. This is a completely different look on statistics, so it'll take a little bit of time for us to get used to, but what I would draw attention to is statistics were up across the board in every category to budget, with the exception of really just that payer mix that I mentioned. I went back and looked at, I'm down at the bottom, the 13% deficit in Medicaid. Medicaid's a little tricky at JPS because when patients come in, they may not have a funding source, and 3 months later they do. That's exactly what happened. When I restated the October patients at current payer mix, we're right on budget for Medicaid. It looks pretty magnified at 13% below budget, but that is due to the approval process in Medicaid. It takes 90 to 120 days. And then, of course, we do see a little bit of increase in our payer mix and self-pay and connections. But all in all, a very productive month above budget. I did look at case mix. It's one of those things that stuck out at a 3.1% reduction. We are seeing the same amount of trauma volume, but a little bit less severe trauma. And I've looked at that, and it's a lot in spinal and fusion type cases, and also cerebral type injuries. So it's pointing me to the fact that case mix is a little lower in surgery because of the type of traumas that we're getting. So
How do you, is a cerebral trauma one and spinals are three? I mean, how do you?
So great question. The CMI, as it's mentioned or stated there, case mix is an acuity index on severity. So a cerebral case might be a 5.8, whereas a knee replacement might be a 1.8. So it's relative severity based on that condition.
Okay.
So that severity index has actually fallen a little bit in our patient population.
Way to go, Tarrant County.
That's a good thing.
It's a good bump. Yeah, that's great.
Go up again. The holidays are coming.
We have competition.
Yeah.
That is the one thing that is are things being redirected to the new level 1 at THR?
Level 2.
Okay. So I believe there's some truth to that. It's very hard to quantify, though, because we don't have their numbers. So I think it's a good point. And of course, length of stay continues to be below target. at 5.41. So any questions on statistics or anything I can point out for you? We'll go quickly through the graphs. Graphs look a little...
I like this better, but I'm not sure yet.
Okay, that's fair. What I like about it is you can quickly see the percentages, and it draws you to what's above or below. And then the graphs, of course, are the same graphs, just a little bit different color scheme. Payer mix I've already talked about, commercial being down a little bit, and then Medicaid we talked about. We are below budget on FTEs per adjusted patient day. That is primarily a function of our productivity, more visits, more patients on, and being more efficient with that labor. And then I would point out cash collections is below the green line. That is due to, we record revenue on our CHIRP patients at the full expected payment, but the CHIRP rates have not been updated until December. So the managed Medicaid payers have not started paying us what we're due until December. So we have a little bit of gap there in our cash collections for the month. And of course, connections enrollment is somewhere around right around 1.8, 2% higher than the prior month. It did not fall. You know, as you remember, we did extend benefits after 1 year, and we do a verification after that first year. And so October of last year was the first year we did that. So we're holding steady in that membership. So.
Rory, one question on the FTE metric, and I may not be here to discuss it when we get to the AIP. A little bit of, because I've got to run at 12:45, but a little bit of a question as to, we're sitting at 5.48 today. Our FTEs per adjusted patient day threshold is 5.8. Target is 5.84 and stretch is 5.79. Just, that doesn't seem like much of a stretch when we're at 5.48 now. So just FYI, thinking through AIP, that may be a low target.
I think you do have to account for that additional volume above the budgeted targets that really came through in the month. So it's worth discussing, I think, in your, to your point.
Okay. Thank you.
Absolutely. So Rory, thank you for the connection enrollment. I'm very happy to see it going up and continuing to go up. In February, can we bring connections in to talk about open enrollment and what they saw during that period of time? Because we've seen so many families that, in the wind down, that have not been. So I'd like to see what that outreach has been.
Okay, for connections or
For
Medicaid?
connections,
Okay.
yeah. Mhm.
Okay. Real quickly, admissions are, of course, above target. We did inch above that occupancy rate of 90%. Case mix, I've already dove into, and then, of course, length of stay. I would point out on emergency visits, it's kind of crazy. This week, we had a 470 patient visit day. And we have continued to see that and average well over 300, but 470 one day this week. So that's just the trend that we're seeing in the emergency department.
New normal. Yeah. It's the new normal.
Yeah.
And is it just, I mean, have we seen what, is it
It's
complications?
not flu, it's not, yeah, it's everything.
Okay. Primary care clinic visits are above budget as well as specialty care. And then kind of look at surgeries for a second. Surgeries were up primarily if you look in the inpatient orthopedic side. That's where we saw a little bit better than expected. So certainly that orthopedic group is pushing through a lot of cases. And then, of course, outpatient surgeries are doing well to budget also. And then behavioral health is above target on all statistical categories. So questions on that? I might backtrack a little bit on the FTEs per APD just based on your question, Trent. we do have to count for new FTEs for new services opening this year, so that's a little bit of the reason of, maybe, there's a lot of factors is what I'm saying.
That makes sense.
Yeah.
And as those new positions mature, then hopefully we begin realizing efficiencies there. But I think globally, it does speak to, that's our biggest cost around here.
Mhm.
Right. If we can manage that cost, then we've achieved more direct efficiency than anything else from a metric standpoint.
So I think you'll see us at Dr. Duncan's urging to get very active in that labor management this coming year. And also, we are developing additional tools to allow nursing floors to see productivity by the minute, not 2 weeks or 3 weeks down the road. So that is a project we're taking on as well. So definitely know and appreciate what you're saying about that is our, 60% of our total cost.
Thank you.
Anything else I can?
Anything on the unaudited October financial report? I need a motion to approve.
Approve.
Second? Second. Got a second? All in favor?
Aye.
Any opposed? Motion passes. Trent, do you, the AIP is on the consent agenda. Do you want to pull that off and discuss that before you go?
No, because I may not be here.
I mean, I can move it and we can talk about it now before.
I will defer to you, Mr. Chairman, whatever you prefer to do. I'm fine either way. I just wanted to bring that up as a point to
Well,
consider.
let's go ahead and move AIP up and we'll talk about it now. Jill, because we talked about this in Human Resources and those movements, I mean, it's such a tight number in that window, and Jill would be better
Yeah, I can
explaining
provide
it.
some just actual data around that. So let me get to my. So FTEs per APD, and I don't know if we have anything from a slide perspective related to that in the deck. But we were looking at threshold of being 5.88, target 5.84, which would be a reduction in about 4 million or about 50 FTEs if you're looking at dollars versus kind of FTEs. 5.79 would be stretch, and that would be doubling that. About 8 million in a savings and about 100 people when you're looking at actual salaries. So kind of relate that to what we're talking about.
Yep. And I don't think those are bad, Jill. And I think when we look at the overall, part of it becomes how much service we're going to be able to take on, PEC and others, to be able to begin measuring against that. And I don't think it's a bad metric. I know, we fought this when I was on the board at Baylor every meeting, and we were always trying to get it around 5.2, 5.3, which their acuity levels are very different than ours. And I understand that. But my point is that especially as it relates to executive pay in the AIP, this is one of those areas where pushing is a good thing. And this is not a gigantic, I think it's overall 20% of the overall bundle on AIP. And so I'm not opposed to it at all. I would encourage us to be able to maybe drop that stretch a little bit based on where we are today. But I completely respect what you're saying, and I get it. It's just the one area I thought maybe could tweak a little bit.
Yeah, and I would just add, I always hate to go off 1 month's metric. We did have high volumes in October. November, we didn't see as high volumes. December, yes, this week, we had a 470 patient day in the emergency department, which is crazy. But November, we didn't have the same volumes. Our occupancy was not the same. And so I think to go off 1 month is a little bit tricky in my mind. And so I also think there's a balance between, and you bring up a good point when you're comparing us to Baylor. We have other resources that have to be available for our patients that other hospitals do. And so we are a little bit different. Bringing on these additional, locations and sites also changes that a little bit. But I respect your comment.
I would only make the observance that I know you guys are spending a lot of time right now thinking about efficiency measures.
True.
And I know that's a staff-wide effort throughout the hospital district, and I appreciate that. And this is one of those places, as we realize those efficiencies, being able to drop this number proportionate to that would be awesome. So that's my only comment. Roger.
Okay.
Jill, our fiscal year 24 number was 5.81.
It was it's the threshold, 5.88.
I'm sorry, the actual, on the slide Roy presented earlier, he showed fiscal year '24 FTEs was, I think, 5.81.
I think we were that high, were we?
Just so everyone knows, the AIP goals are on page 220 of the portal.
I'm talking about actual numbers, not the AIP. Let me see if I can find the page.
I think it's 156.
156, thank you.
You're talking about where we ended.
Right, if that's the FTE justification days that it looks like we're showing.
FTEs for fiscal year '24 on page, that's on page 156 is correct, 5.81.
I'd have to reconcile the difference.
Well, I mean, is there something to reconcile? I just thought that's what the number is.
I think you're looking at the 5.88 as our budgeted. If you look at the green line, those two match. So we budgeted at 5.88 because of that increase in FTEs that I mentioned. The budget is a little higher than what our actual was from the prior year. We're onboarding medical home and things of that nature. So we're not going to be necessarily below last year as we begin 25. So 5.8 matches the budget.
But that's a high, I guess, I don't know how many FTEs you're bringing on, and so that matters. But I think if you just look at it, if you're saying this is where we were, and even projecting FTEs, that optic doesn't look right.
Well, I would.
All right, that's all I'm saying. Just know.
I definitely hear you, but, you know, there's also a significant projection in correctional as well, that we're taking on a new correctional group of inmates soon.
400.
So I think you got to look at both sides of, you're here, but you're budgeting slightly higher. And so I think there's more than just optically you're higher than last year.
Oh, we really aren't higher than last year.
There's some anomalies that I know we're planning for here, and correctional is obviously one of them. But I mean, like PEC coming online, when it comes online, we shouldn't see a gigantic increase
No.
in staffing as a result of that. And most of the things that we've talked about in terms of staffing trajectory are not gigantic staffing increases relative to the facilities plan as we look at it now. So I would
also point out that additional volume that we're budgeting does not come without some staff. We're not projecting 100% efficiency with new volume without any additional staff.
Okay.
So
That's an important point.
Yeah.
Because to the extent that we see volume go above budget, then anticipating that makes perfect sense. Just not sure it makes that much perfect sense. But maybe.
So Trent, are you asking that we consider stretching a little bit more?
Yes.
Okay, and so we're currently where with stretch?
5.79. And so essentially what we did was this will probably simplify it. Target was a $4 million reduction. Stretch is an $8 million reduction. So we could stretch to a larger amount, like 12 million, double that.
Okay.
Would that be?
Yeah, would that be, I mean, we could.
And that counts for Fit for Growth initiatives?
It would be included in that.
It would be included,
Yeah.
yes. Okay, let's go ahead and move forward with that.
So that's roughly another.
I'd have to get the percent, but yeah.
That makes sense.
But they calculate it.
Then we'll watch it each year and see what happens.
So Jill, 5.79, that's a savings compared to budget of
8 million.
8 million? And so you're suggesting make that 12?
12 instead of 8. So the target would be a $4 million reduction. And so then to 8, instead of 8, go to 12.
That should knock it down to about 5.75.
We'll make sure, get the exact amount.
Your math is much faster and better than mine.
Like, I'm good.
If you say it with enough confidence.
Yeah, right. Yeah.
Yes.
Could be completely wrong.
Just said it.
Thank you. I appreciate
Okay.
that, Russ.
Are there any other questions that anybody has on the AIP where we can?
Go ahead, Amanda.
No, go ahead.
I just wanted to compliment Jill and please, shout out anybody that should be thanked for the work. I brought up this idea a year and a half ago of adding some financial metrics for the AIP, and that's easy to say. It's harder to think of what those metrics should be and then track the metrics so that this is manageable. And Jill came up with, for the executives and the other employees, some very meaningful metrics that will actually have a significant impact on the financial strength of JPS. So thank you for coming up with these. I think you did an excellent job.
I can't take credit. It's our entire executive team, specifically finance, Whitney, Franklin, and Rory, as we're working through the financial metrics. And so, but really, it truly is a representation of the entire team, because we have quality, we have employees, we have patients, we have financials. And so it truly takes all of us to spend a lot of time to get these forward to you guys. So thank you, Blake. I appreciate it.
So, yeah, I just had a question on the stretch on the external funding bundle. I'm fine with it. I understand we're rebuilding, but I just want to state, I think that stretch could and should be a lot higher than the 31.5 million, just in what we're seeing in the funding community and also the work of JPS. So just FYI, I'm okay with it. I do, but I think right now, and I went back and listened to my HR meeting like a good board member should, just so I understand the explanation on why, and I'm fine with it.
There wasn't we spent a little bit of time discussing that, and I think that for all of us, we have a new leader there at the foundation, that
We'll give her some time.
that
Yeah.
expectation is that number grows exponentially.
Has to
but
be- it's an
one of those, there's a
implementation
pipeline, and
stage.
it's going to take time. It's going to be a build, and so we felt that it was appropriate this year, but then really taking a hard look at that next year, because that number, especially when you start looking at naming opportunities and the master facilities plan and those kind of things, we do expect those dollars to be significantly higher.
Well, thanks to Dorothy and that committee. I think this is a plan that we need to get out as quickly as we can. I think we're 6 months ahead of where we were last year or something like that. And I think we owe that to everybody that works here for that. So thanks for your hard work on it.
Yeah, the HR committee, Blake and Trent, has spent a good bit of time as well looking at those finance metrics, and we appreciate everybody's there.
Started working as soon as we finished last year. They've been meeting on these, so I would like to compliment them on what they did. Yeah. So I'd like to thank them for all their work and listening and being reasonable, and when I'm being unreasonable, y'all are being reasonable, so I thank you for that. And in a respectful way. So yeah, I really do appreciate the work you've done on it. Okay.
Blake, would you like to make a motion with, as noted?
Approve the AIP as presented, with one change being the change in the stretch goal for the FTEs per adjusted patient day to a savings compared to budget of $12 million. That's my motion.
Okay. Got a motion? Second.
Okay.
I got a second? That was Trent?
Trent
second. Any further discussion? All in favor?
Aye.
And any opposed? Motion passes. Thank you. Sorry for the little detour there. I wanted to make sure we had Trent's comments taken care of. We'll move now to item D, consider approval of professional service agreement between AGS Health and Tarrant County Hospital District.
Okay, I will be gone after this one. So, this is a contract for AGS Health. We supplement our coding staff due to volume increases, and so we went to RFP. Coding has been one of those areas where over time you tend to lose a lot of the workforce, and so this is an opportunity for us to use a supplement company to do that. RFP was 14 different respondents, and so AGS was very affordable, the most affordable, and we were requesting your approval for roughly $600,000 annually, $700,000 annually and $3.4 million over a possible 5-year contract.
I was going to say, you're rounding the wrong way.
Yeah, I've been up here a while, Roger.
Yeah, right. Is there any discussion? All right, I'll ask for a motion. You got a motion?
Second.
And a second. Any further discussion? All in favor? Aye. Any opposed? Motion passes. Thank you,
Thank you.
Rory. Thank you so much. We'll go to item E. This is a group of change orders. We'll actually, if there's no if there's no disagreement, we'll take these as a package. Jill, if you could just talk to us.
Deborah, do you know what page we're on?
We are on page 164 now.
Thank you.
We'll take a motion and a vote for all of them, but if you could just run through each of them, please.
Yep, absolutely. There are several change orders here related to the new parking garage project between Beck Potier Joint Venture and the hospital district. All of these changes are in the current PEC budget, but this is really a function of allocating those dollars to the construction budget of Beck. So the base contract was approved back in August of '22. So change order number 1 is related to a project extension due to soil contamination, as well as the creation of a CFA with the city. And so that change order is $462,000. Change order number 2 related to site security and safety. So any kind of entrance security measures, gate guard labor, that sort of thing, $383,000. Change order number 3 is for exterior signage in the amount of $376,000. Interior signage is change order number 4, $269,000. And finally, change order number 5 in the amount of $834,000 is the mitigation and disposal of contaminated soil when we were excavating from the foundation. So similar to the soil that we found across the street at the temporary parking location.
Trent, I guess we've got our finance and planning hat on right now. Is this along the lines of what you're thinking? Yeah.
Yes, it has been.
I think that's a great idea. Yeah. Move approval.
Question before we
Sure, Blake.
vote. So Jill, are these changes, there's 5 of them, and it's about a couple $1 million, I guess. Are these changes that are actual changes to the garage as designed and bid out?
Or changes of movement of the financials into the construction budget.
So they're not really changes?
No, but they're considered change orders because we're moving money.
Not
Okay.
changes in scope.
It's not like something
Changes in
we had
the
to do.
project.
Like we have to have signage. We didn't think about that.
No, it's moving of those dollars to the Beck construction project, or Beck construction portion of the project.
Okay, thank you.
Yep.
All right, I've got a motion, and I've got a second. Any further discussion? All in favor? Opposed? Motion passes. Thank you. We're going to go to item G. Item F, I've been requested to pull from, staff asked me to pull, so we'll go to item G. Ashley. Is it afternoon already? It is.
For our annual stop loss coverage, which is the coverage, as you all know, that covers us for catastrophic or large claims above and beyond our internal, what we pay for our own insurance. There is a slight increase to that policy, as is typical. There's a annual percentage increase that we typically see across the market. We are going with Unum, who we've used in previous years, and so are there any questions I can entertain about our annual stop loss coverage?
This is year 1?
So we renew it every year. Every year it comes back.
Okay.
Did you say the insurer is Unum?
It is.
The vendor, though, is QBE. Is that like an agency?
I believe.
The wrong one.
Are we looking?
No, you're looking at the wrong one. That's QBE is Qualtrics. So that was what was pulled.
That's, go to the next item. You need to be on page
176?
176.
176, yeah.
TE Insurance Corporation.
That must be the.
That's their legal entity name.
We're talking about the stop loss policy?
Yes,
Yeah.
proper name.
Yeah.
So the insurer is, it doesn't say that here, but it says, but the insurer is Unum.
Yes.
And then, but the vendor is QBE Insurance Corporation.
Yes.
Is that a Unum affiliate or an insurance agency?
The legal entity name.
Yeah,
that they
just the
gave us
legal
on the
name that they gave us on the contract.
And it looks like McGriff was the consultant on it.
That is
Blake, you see
correct.
that on?
Yeah, McGriff is our agent, yeah. I just, if it's Unum, what's QBE?
So, I will dig for you. I don't know the answer to that question. That's what's on the contract, so I don't know the answer to that question, but I can get that answer back to you.
I tell you what, is that something we can do like at the end of this, or?
Yep, I can get it to you in a couple of seconds.
Okay, then why don't we put you on hold,
Okay.
We'll table this for a second. We'll get the Joy Parker show, and then we'll come back. Finish our day with the Ashley Ridgeway Washington show. How's that? Hi, Joy.
Good afternoon.
Hi there.
Rory does, he says JPS, Joy Parker Show. I thought that maybe he told you that.
No.
As a joke, but yes, no, I have quite a few contracts. So the first one up is asking for your consideration of approval of a second amendment to
This is page 178.
Oh, thank you.
Sorry.
Right. To the service agreement between HHS Environmental Services, this is our EVS provider, in the district. This carries a cost of over $1 million. It's approved in our approved in our operational budget. This allows us to expand, to add FTE for opening of Medical Home Southwest, PEC. So the expansion for Medical Home Southwest, as well as allows an annual COLA for the employees. So this are EVS team members. Asking and seeking your approval for this amendment to the HHS contract.
Move approval.
Second.
Okay, so this is amendment adding those facilities?
It's adding on the new facilities for the master,
Okay.
yes, master facility plan, which is inclusive of that increase, a merit increase for the staff members.
And HHS Environmental has all facilities?
They do a good job.
Yes, they have all of our over 1.9 million square feet.
Great, thank you. I've got a motion. Who had the second?
I second.
Dorothy had the second?
Yes.
Any further discussion? All in favor?
Aye.
Any opposed? Motion passes. Thank you.
All right. This next agreement that I'm bringing forward is consider approval of the governing letter between Hologic Sales and Service and the district. This is also included in our capital budget. This agreement allows the district for us to procure 2 mammography units and 1 DEXA unit. The governing letter is essentially allowing us to do a bundle payment and quotation to acquire this equipment from Hologic. So I'm seeking your approval, and this was, the procurement was through Vizient, through our GPO method of procurement.
Where are we putting the?
These are going to go in our Health Center for Women main campus in order for us to do the mammography screening services, of course.
Do we have our own radiologists to read these?
We have an agreement with, RANT Services, so our LIP is Dr. Ford, and so she works with our team for this, for mammography services.
Is there a legal difference in a governing letter and a contract?
No. No, that's just how they title it.
So fancy.
I know.
It's fancy.
I know.
And we give it the name of the
And do we
document.
own these, or are we just renting these?
These are owned. We would own these.
Any further discussion? For a motion?
So moved.
This next contract,
Hang on. We got a motion? You take the second? All right. Dr. Fowler, okay, motion. We got Ralph with the second. Okay. Any further discussion? All right, all in favor?
Aye.
Any opposed? Motion passes. Thank you. Who's ready to go?
I was trying to keep it going. I know. This next agreement that I'm bringing forward for your consideration is to approval of the maintenance agreement between Southwest Elevators and the district. This cost is included in our approved operational budget, and it provides the professional services, the technical support service, preventive maintenance, and repairs for all of our elevators. And we went out for RFP. We had 4 bids that came back. Southwest is our incumbent. They've been providing a good service and responsiveness for our organization, so I recommend that we execute this agreement.
Southwest is the one that came in a few years ago?
Yeah, that after.
Yes.
Yeah, okay. All right.
Right.
Yeah, they've
Got a
been good.
question.
Yes.
Yeah.
Are they required to indemnify us of any loss we suffer as a result of their activity in this contract?
We usually do put in liability language for them. It's heavily negotiated. And obviously, if we felt that they were at fault, that we would go after
And
them.
that is in this contract?
I presume
There's an
it is.
indemnification clause. I would look to Daphne for the details on it, yes.
Okay. This is just a unique consideration.
Yes.
Yep, it's 6, number 6 on the,
In the contract.
in the contract, sorry. Exhibit A.
Okay, any further discussion? I'll ask for a motion.
Move approval.
And a motion, and a second. Any further discussion? All in favor?
Aye.
Any opposed? All right, motion passes. Thank you.
All right, this next one is seeking your approval of the maintenance agreement between Brandt Companies and the district. This is also included in our operational budget as approved. The purpose of this agreement is to provide the preventive maintenance and repairs on our chillers and cooling towers throughout the network. We went out for RFP for this. We had 3 bids. They were awarded based on best value to the district.
Okay, any discussion? I'll ask for a motion.
Move approval.
Got a motion? Second. Second. Any discussion? All in favor? Any opposed? All right, motion passes.
All right, this next one is seeking your approval for the purchase agreement between GE Precision Healthcare and the district. This cost is included in our capital budget, and the purpose of this is to provide the organization 5 X-ray units that would go throughout our network where there's need. We utilize our Vizient GPO pricing for this purchase, so seeking your approval to agree to purchase these.
Are these replacements for current portables?
Some that were, yes, that are aged and past their useful life.
Not MRIs yet.
You know, we have our MRIs on the way.
Oh, wait, okay. So move.
I got a motion.
So moved.
Coming.
Is this what we currently use, the GE?
Yes, this is.
So it's just what?
I've got a motion and a second. Any discussion? All in favor?
Aye.
Motion passes. Thank you.
All right, for this next item, I'm actually bringing up my colleague here. So Phyllis and I are going to speak because her item with stretcher beds, as well as what I'm presenting for the OR air handling units, go together for that project. So this first contract that you have is consider approval of our construction manager at risk, our CMAR agreement between Batson Cook and the district. This is included in our capital budget, and this agreement provides for the labor, the supervision, the planning, in order for us to replace our OR air handling units. We have 5 of those and then 2 chillers. And so this agreement would allow us to do those necessary repairs that we need for our OR units for our OR project.
Is this the second phase of this? Didn't we just weren't there 3? I'm trying to remember.
No, this is part of that work.
It's
Yeah.
just
We
a
have not
continuation
started-
of that.
No, we have not started
Okay.
this work.
Yeah.
We've talked about.
All the
it for a while.
conversations run together. I'm
Yes,
sorry.
That's okay.
That was the planning process.
Yeah, okay.
How were we going to
Okay.
do it, cutting down a lot.
This is, yes, for the spring. So in the
Okay.
spring, we're starting, and so this is necessary in order for us to stage for
This work will
the
be
OR
done as
upgrades.
part of that.
Yeah.
Okay.
And these are ORs that are staying put?
Yes.
We're gonna-
Yes.
Even with the new buildings? Okay.
Yes.
Okay. And then how are you involved with the beds? with the air conditioners? I need to know the connection.
I have the OR, and I'm really up here piggybacking with Joy just for clinical efficiency in the event that you ask a
All right,
clinical
great.
question.
Okay. I didn't know how they went together, but whatever. I'm going with it.
Why do we need Next Ask supports this
Okay.
project, so.
All right, well, then I'll ask for a motion on item N.
Move approval.
Item M. I've got a motion and a second. Any further discussion? All in favor?
Aye.
Any opposed? Motion passes. Okay, Ms. Phyllis.
Yes, so the next one, in that same vein of that contract, is just for our cameras for our OR. They are at end of life at current, and so this would be a replacement for them. So I'm asking you all for $3 million. Whew, I feel like Will up here,
Yeah.
$3,015,160 as approved through the capital budget. So.
These are wall cameras?
These are cameras in the OR that will be stationed in the midst of those rooms that'll help with our residents who also will be getting, be there for residency, for teaching purposes, as well as efficiency to move through the OR, be able to share those cases. The physicians will be able to come back and say, how did we do with those cases? How well did we do? So it will overall affect patient outcomes in our surgical suites.
Their installation is going to coincide with the...
Correct, with everything else that Joy brought up.
And again, to follow up on Margaret's comment earlier, these are in ORs that are going to
be with us for a few years.
Correct.
Yeah.
Do it.
Move approval.
Okay, got a motion?
Second.
And a second. Any discussion? All in favor?
Aye.
Motion passes. Thank you.
Mr. Chair, can the minutes reflect that I'm abstaining or recusing or whatever word we use on this one?
Okay.
On the one regarding Stryker. I probably should have said that at the beginning.
Oh, the Stryker, item N. Okay, that is so noted. Thank you. Dr. Carl Putti?
Good afternoon. I'm continuing the trend of OR needs. I bring forward a proposal for our anesthesia services. The district sought responses for providing RFP for the anesthesia services, and we got 5 responses. After a very thorough and sometimes intensive process, we were able to identify Sound as our selected vendor. They were selected because of the high quality and value they provided from all the vendors that we selected. So the agreement, the request is to get a professional services agreement between Sound Anesthesia and Tarrant County Hospital District. The annual expense for the contract would be $21,873,000. This is included in our operational budget, and then the contract would be for an initial term of 3 years, and then for 2 one-year renewals, and with the possibility of having the contract for 5 years with a total spend of approximately $109 million.
Is Sound currently?
Sound is the
provider?
incumbent, they are the current providers.
Oh, okay, that was my question.
And we've had a good relationship with them.
Sound has had a relationship that has become good over the years.
Okay.
Dr. Carla Putti, how did Sound compete with the other, there were 4 other competitors?
4 other competitors.
How do they all compare on their pricing?
Sound actually was the lowest price in terms of the 5. Sound also actually came up with proposals that were more in line with what we wanted to do and also improve our efficiency. I think the other vendors, the way they calculated the FTEs that they needed for the work that they needed to do were significantly higher. And then there are some vendors we would really not know the quality of work they would produce. We also have a few areas in JPS that are specific. For example, we need OB fellow trained or OB experienced anesthesiologists. That is a field of anesthesia that not every provider can provide. We have specialized cardiac anesthesiology needs, and that's another thing that all vendors cannot provide. So those were the things we considered in understanding not just what they can provide, but what is the subspecialty of anesthesia that the other vendors could provide too.
Okay, thank you.
Do they guarantee to keep Dr. Horak and Dr. Singh involved?
We did not get into that detail.
They won't put that in writing. They're outstanding.
But we did say that any significant personal changes have to be approved by JPS before they can be made.
Okay.
Do we consider just showing the patients videos of these meetings to put them?
That'll get them to sleep pretty quick.
I want to respond to that, but I will not.
Good one. Actually, that is revenue generating.
I thought we were doing pretty good here.
Wow.
Lost all control. Any further questions? I'll ask for a motion.
So move.
I've got a motion
Second.
and a second. Any further discussion? All in favor?
Aye.
Any opposed? Any abstentions? Okay, motion passes. Thank you.
Is it sanitary?
All right. If they weren't asleep, they'll wake up now because Mr. Showalter is going to scare us to death.
Merry Christmas to you, sir.
We sleep over a lot of things up here, and this is one of the top deals, so.
It's good.
So I've got 2 contracts, both with existing vendors, so I'll just do them together if you don't mind. First is with First Data Bank. We've had First Data Bank since we went live with Epic. We actually use the product MedKnowledge, which is the drug database. So it's a sole provider. The second contract is with Duo, and Duo is our multi-factor identification tool. Get the little handful of digits when you're remote, et cetera. Duo was sold and bought by Cisco, so we're actually moving the paper and extending the contract under the Cisco EA through General Data Tech, and we should be saving we will be saving $240,000 over the life of the contract.
Okay, well then, Merry Christmas. Okay, great. All right, we'll take them individually. Are there any other questions
Yeah, Will, what is the relationship between General Data Tech and Cisco? Are they like a broker?
General Data Tech is the VAR, the value-added reseller. Cisco doesn't sell direct, they sell through the value-added resellers. And GDT is on the Texas DIR.
Okay. I'll ask for a motion for item P, consider approval, additional spend license agreement between First Data Bank and Tarrant County Hospital.
Move approval.
Second.
Got a motion and a second. Any further discussion? All in favor?
Aye.
Any opposed? Motion passes. All right, great.
Thank you very much.
Let's go to Q, and we'll do approval of the addendum to the DIR contract with Cisco and whatever, General Data Tech.
Okay. Move approval.
Got a motion and a second. All in favor? Any opposed? Motion passes.
Catch.
Okay, great. Thank you. Zelia, hello.
Hello.
We're going to pull item R as well. That was a request from staff, so we'll go to item S.
Thank you. Good afternoon. I am here to present a contract between professional services agreement between MHMR of Tarrant County and the hospital district. This is a revenue contract for the
Merry
amount.
Christmas to you,
Merry
Zelia.
Christmas. $12,777,120 for this fiscal year. And just as a reminder, this was a result of some intense advocacy with JPS Hospital, Ashley, and with the legislature last biennium. And so we're going back again this biennium for more. But
All right.
Yay.
Yeah.
Excellent.
It will be strange for MHMR to give us money, so.
That's true.
What are we offering them? We're just giving them.
So this, they are the pass-through agency from HHSC. And so we contract directly with them, not HHSC, and they pass through those dollars for the 48 state hospital civil commitment beds that we operate.
The funds. Okay.
Correct.
Okay, any further discussion? Ask for a motion?
Move approval.
Okay, got a motion and a second. All right, all in favor?
Aye.
Any opposed? Motion passes. Thank you. All right, Dr. Elliott, hi.
Hello.
Good afternoon, everyone.
Hello.
I am here seeking approval of the Second Amendment for the medical education affiliation agreement that we have with UT Southwestern Ophthalmology Group with the Tarrant County Hospital District. This has been budgeted in our operational budget for over $504,000 for a one-year contract term for this Second Amendment.
This is what you presented to us last year. It's the same.
Yes, so we're doing a one-year extension at this time.
Yeah. Are we going to just extend it annually, or is this?
We'll be exploring what this can look like in the future for longer term and making sure it aligns also with our professional services agreement, working with Dr. Carla Pudi and the team. Yeah.
What are the program director duties? Is that someone that has a role similar to yours for our GME program, or?
Not particularly my role, but each program has definitely oversight where you need to make sure that the residents are getting what they're needing and providing that oversight. So program directors usually kind of report up to my level in terms of the DIO, but every program needs to have some site director or program director, somebody that's making sure that they're meeting the requirements around ACG.
And is that usually an MD or DO?
MD or DO.
Okay, and that's what this is basically funding, is the program director?
It's partly that and the faculty also, because there's faculty that come here, and so of course there's time around non-billable time around supervision and teaching and things like that that must occur to keep the program accredited.
And how long has this been going on like this, that we've been working with UT Southwestern on the ophthalmology program?
It's a long time, over 10 years.
They
It's been a long
are
time.
our ophthalmologists here.
Yeah, they are. They provide a significant service and access for our patients, and we get 4 residents also come with them also every month, and the faculty are here also. It's
Which I have
critical.
to say, for a hospital to have emergent ophthalmology is a unique thing. So it's actually a great service to provide.
And Margaret, you may have asked this earlier, are we going to keep extending this 1 year at a time, or are we going to do a multi-year agreement?
We're going to be exploring what that term can look like in this year that we have. So this gives us an opportunity to have more detailed discussion and align with the professional services agreement and see where we move forward with.
Okay, thank you.
Okay, any further discussion?
This is the total cost for ophthalmology coverage?
This is the faculty cost.
Just the faculty portion
Just
of it
the
too,
faculty
but that's, yeah.
No, this is the faculty educational portion.
Educational,
Yeah,
okay.
there's another portion with the professional.
I was like, wow.
No.
It's a pretty good bargain. Yeah.
Our professional
It's on
services that
sale.
are provided outside.
20-year agreement with them, if that's
Yeah. No, this.
Doorbuster.
Right, yeah, solely the educational component, yes, and this is just the faculty educational, not the resident piece, so.
Okay, great. All right, I'll ask for a motion.
So moved.
Got a motion and a second?
Second.
And a second, all in favor?
Aye.
Great, thank you.
Thank you.
Okay, Phyllis.
Let's go back to Ashley.
Oh, we'll go to Ashley, I'm sorry.
Has the board seen Men in Black? I need everybody to come up here. At least from your memory of prior discussion.
So I am back. Today was that time being a chronic overachiever smacked me in the face. So as I prepare for this, I often look at the summary from the year past and review it. And so what I referenced was incorrect. Unum, in fact, is not our stop loss provider for the fiscal year going forward. It was our stop loss provider for last year. And so QBE is in fact the vendor that we're contracting with for this year. And we will be leveraging them for stop loss. They did provide us with the most competitive quote, and it was consistent with what we expected based on the number of catastrophic claims we had for this far in the benefits year.
Move to approve.
Okay, got a motion?
Second.
All in favor? Aye. Thank you for the clarification.
Absolutely, thank you.
Oh, okay, wonderful. Well, it's that time of year that we review the nurse staffing effectiveness. So let's see if I can get this one going. All right, so the purpose of us actually bringing this to the board is that it is Texas legislation that we are mandated to bring it before you. It's also mandated to be reported annually at our hospital governing body. So the scope of this actual presentation is the development of a nurse staffing policy, as well as reviewing and assessing the respond for staffing concerns from our staff. We will also identify nurse-sensitive outcomes and indicators such as patient falls and pressure injuries. And then the stakeholders in this is everyone that is a nurse. So the nurse staffing committee that oversees this is made up of 60% bedside staff nurses, the CNO directors, as well as managers and team leads. We also have from HR a nurse recruiter and quality services. Our function is to look at nurse-sensitive concerns, and best practices are actually reviewed. And so our staffing processes are reviewed through these individuals. Minimally, they meet quarterly to track and review the submissions for the division, and then they action plan around those indicators if there's some circumstances that we need to address. The nurse-sensitive indicators are transparent data as you go to all departments and plans. So what are nurse-sensitive outcome measures? They're actually falls with injury and pressure ulcers with injuries. And then human resource indicators within this committee are nursing hours per patient day, as well as nursing and support new hires, and then nurse staff committee submissions. So each individual department is able to submit if they have a staffing concern to this committee, and that committee takes it up and resolves for those issues. All right, so first nursing sensitive indicator, which is falls. The lower the number, the better. We fall within the 50th percentile ranking. So the lower we get, the better we get, as indicated by this chart that I'm showing you now.
And then what are we doing around those indicators? We actually have a new cognitive fall risk tool that's coming through Epic soon. So we're working with Will's team to ensure that we can assess those falls every 4 hours so that we have better indicators and predictability for those patients. Data collection continues through our MIDAS system, which is our risk management system for reporting falls. And then we have post-fall huddles on the unit right at the time of the falls. Operational staffing interventions, utilization of telesitters. We like our technology, so when I ask you for $3 million on any given day, I'm asking you to keep our patients safe. Staff assistance as well with ambulating and implementation of rounding as well for nurses within the room. Education equipment-based interventions include encouraging, of course, of gate belts, old school, but still effective nonetheless. And then rearming the bed alarms when we leave and making sure that we have no pass zones as we round. Next slide is hospital-acquired pressure ulcer injuries. And so with this, of course, the number being lower is better, and we've achieved that from fiscal year 23. We were at 218. We've been able to drop that down to 187 for fiscal year 24. So very proud of the work that's going on. And as an indicator, as we start off this year, we're starting it off well. We only have 9 falls recorded for the month of October. And so what are the interventions? We actually utilize our partners with this nursing sensitive indicator, which is the institution of our respiratory therapists. You say, what do respiratory therapists have to do with this? Well, as we have some physicians around the table, we are aware that when they have BiPAP machines or face masks, that causes pressure as well. If they have a tube, that causes pressure. If they have a Foley, that causes pressure. And so we asked our respiratory partners to come in and help us in the ICU with rounding clinically, as well as our resource specialists. We have wound care nurses certified, and then we have wound care RN buddies, which are tech-like positions, which they help us come turn so that we can status those. One of the number one indicators that tell us that we end up having falls is usually because we assess them incorrectly upon admission. Increased skin and wound assessments through our SWAT team nurses and membership and support from all nursing units, as well as continued multidisciplinary wound meetings. So we get with Dr. Batamosi's teams and we look at our quality and ensure that we've got good plans around reducing HAPIs. And then a continual dual wound care nurse verification of all hospital wound and injuries. So we treat every wound as an RCA. So a root cause analysis is pretty much performed every time that we have a wound. So what's the wins? Over this past year, we were able to decrease HAPIs by 11%, and with our RT partners, we were able to decrease the incidence of pressure ulcers caused by those devices by 11.
I can't remember if it was last year or the year before, but it was a while ago that we talked about, and I think we approved some sort of device that's worn by the patients to remind the turning. Is that impacting this as well?
So the LEAF system actually is just not hospital-wide, so I didn't include it in here, but actually, yes, it has been instrumental. I've actually been asked by the nursing partner, so I might be coming back to see if we can also include that a little bit more widespread across the hospital. So yes, that data has shown improvements, and I probably will future-wise be coming to ask.
Where is it in the hospital currently?
So currently it's in our ICUs. We're utilizing the LEAF program.
That's it, just the only ICU.
Yes.
Yeah. So
Yeah.
It was a while ago, right?
Pardon?
We approved that a while ago.
Yeah, last year.
Last year.
Hospital-wide, but it's not. It started out in the ICU as like a trial program, I believe, and then we approved it.
It was on a pilot.
I probably presented it. So it was in our ICU, and we expanded it to some areas of our PCU units. Again, this is usually for patients who don't move around, and so if they're up walking, LEAF units won't necessarily work on them, so you have to be really particular on the type of patient that you put it on. But yes, it was in the ICUs, came back and asked for more units for some of our PCU areas for those patients who aren't mobile.
Thank you, Jim.
Just a question, if you have the experience on the LEAP system, how do the nurses like it? I guess it makes them do a lot more work because those alarms are going off.
So actually, we manage it a little bit different. We try to manage it up to say that you'll actually be in the room a lot less because you're able to intervene a little bit more proactively than you would reactively. So if something else is going on in the room, that program has assisted us in being able to go in, pay more attention. If you think about it, if you go to bed at night, if you had a camera on you in your bed, you would probably move about every 5 minutes. So every hour turn or every 2-hour turn is actually a while. It does help in preventing the ulcers that patients would acquire. However, it's not the movement that you would typically do. Data shows that we touch our face over 200 times a day, but you don't notice it, but you make that movement. So nurses do like it for that reason. That's why I said I may be coming back to ask, because it is widespread. So they've actually seen it as more of a help, because if you have to turn a patient for a wound, it probably will take you anywhere from 30 to 45 minutes to actually dress a deep wound that a patient would have. And you need more hands in the room because you're going to need somebody else in there to help you turn, stand there, hold them while you dress that wound. So those are the benefits for us.
Good, thank you.
Yeah, absolutely. All right.
So I'll know not to touch my face anymore.
Yeah, it's amazing what you will learn when you get into some of the articles that we read. All right, so nursing hours per patient day, big satisfier for nurses. I'm going to tell you, JPS has done a wonderful, phenomenal job. This was sitting somewhere more around 11 where I came from, so the higher the number, the better. It's sitting at 13.97 here, which allows us to give better care to our patients and have better ratios. So my hat's off to Jill, Dr. Duncan, for that support, because just as a new person coming in, I have not seen it actually that high in some southern states. So my hat is definitely off for the support of nursing here, the continued nursing support. Because the FTEs are in there. So now we have...
With that question, since we just talked about an AIP where the goal is to reduce the FTE somewhat per patient day.
There you go.
Is the implication here that that's not in nursing?
Correct. That is absolutely correct. Thank you. See, he gets it. All right. So these are our subcommittee or our committee submissions. So as I told you before, they are able, if they have a concern about staffing within their particular units, these were the submissions that were made. So we had one in January, we had one in May, and we had one in June. So we're doing a pretty good job of ensuring that everyone is staffed the way they need to. I know you all have heard in redundancy that we have 470 patients in our ED, and we dispatch nurses down there to help with turning, to make sure that we're rounding, and the CNO goes down to round at 7 a.m. to make sure that that staff is satisfied with the staffing that they have. All right, and then nursing support staff new hires, a little bit about the work that has been done over the past year. So we have 75 RNs that have been new hired within September. As you can see overall, RN hires was at 588 RNs, and we hired 257 tech or support services for our nursing group. I'm telling you, I hear you, Ms. Dorothy, it's great. It really is. It was impressive. All right, and so what are we doing about our retention and recruitment efforts? We have increased staff recognition, of course. I see wows go across. Many emails and text messages that are sent throughout the day just to honor staff. We have our practice governance councils, and so nursing has great transparency at all levels. We have our nurse leader focus rounding, our DAISY Awards, which I actually get assistance from this team as well. I think Ashley accompanied me Tuesday morning at 7 a.m. to give that DAISY Award. So our executive team is also showing their support. Pathways to Excellence, of course, our accreditation and reaccreditation. Our NPDP, which is a clinical ladder ability for them to get points as they get certifications, as they get higher degrees. We want to recognize them for going above and beyond. Our mentorship program, because every nurse needs a good mentor. I have 3. And then working with talent acquisition on focused recruitment efforts. And I want to say notably, since I've come right there, we have LPNs in our community services who are going back to school to be RNs. And so we just newly implemented them being able to have a interview process, because you can think that they've been in their roles, some of them 15, 20 years. And so when I arrived, I said, well, let's get them up to speed with interviewing again, as well as resume writing, so that they can be successful within our system as they interview for those RN positions. And then we have our experienced RN hiring events, day, night, evening. Ashley's team, they assist us in making sure that we do that, and we have a presence some evenings, some mornings. We just have various times. And then through those focused efforts, we have had, with the seasonal contracts that we've had 80 to convert to being our staff. So some great work around that. And then we decided, okay, well, we've got to be able to do some heavy lifting. So now we're getting a little bit more flexible in increasing the frequency of our new hire orientation dates. So when we can get them to start, we get them in here. We like to call it the Amazon effect. So the data is right before you, 82 and 21, 107 and 22 for our residencies, 23 we had 155, and ending with a whopping 165, with more to come on that, because I'm actually pushing the team a little bit further. We have a dependency right now on our residents, because nurses, I'm not going to say my age, but they are not trying to come onto the floors and be, frontline staff anymore. They take it, right now they're more interested in the telehealth programs that you have. If you got a sciatic nerve like mine, you probably are not going back on the floor. So we have a high dependency on our new grads. And so the more of those that we can get in, have mentorship, be able to govern them and give them staff recognition, that's where our main dependency is. And then our Reach for the Stars program, which was initiated in the fall of 2019 here at JPS. I had the honor, and I call it an honor because it's nothing more heartwarming. You must bring your tissues as you watch these young men and young ladies come in and interview for this scholarship. It's a scholarship that we have an outside donor who has designed to provide assistance to the eligible JPS team members to further their education. Some of them may have dual degrees and decided to go into nursing, but they oversee that, as well as tenured nursing staff, to get that scholarship to our frontline staff and those who want to be nurses. So really excited about that program. And as well for that, it also helps with the ability of being able to do this function actually twice a year. Our scholarship committee is 10 to 15 recipients for twice a year, in the spring and in the fall. And then we have had 106 JPS employees that were nursing students that have actually received the scholarship, and we were able to keep and onboard 60 of those nursing graduates. And the various departments are, of course, in nursing, community health, patient access, nutrition, radiology, phlebotomy, behavioral health, lactation consultants, women's services, pharmacy, trauma registry, clinical engineering, house operations. And the reason why I shout out to all of them, because nurses touch everything. So, any questions?
I had 2 questions, Phyllis. On this scholarship program, it's a pre-licensure degree, like, is that a BSN or?
So for the recipients that I saw go through that program, actually had to be accepted into a BSN program, and I believe it was after or right before. Jill, do you know if it was the associate degree program as well? I know we have a partnership with TCC, which is separate from this, but I'm not sure.
Yeah, it's for both.
Okay.
They actually like associate degree nurses, but it is pre-licensure. So once they've received all their credits and they've been accepted into the nursing program, albeit a ADN program or a BSN program, then they're eligible to apply for the scholarship.
How much is the scholarship?
It covers all tuition, whatever that is. They also get a stipend to pay for, previously they were doing some reimbursement for computers and scrubs and that sort of thing. Now they just give a stipend, I think it's around $2,500 to the student up front to go buy scrubs, laptops, or whatever they need to be successful in school. The other great thing is it's an associate degree program. If you're in an associate degree program, you graduate. If you enroll in the BSN program within 6 months of your graduation from the ADN program, they continue on and pay for your BSN as well. And so it can be a long-term commitment for those JPS employees who are, getting into this wonderful scholarship program. Again, it's an individual donor foundation. They only do it for safety net systems across the country. Parkland and JPS were the first two because they're local, but they're all over the country. They're at Grady in Atlanta recently, coast to coast. And so as Phyllis mentioned, twice a year they actually come, the donor and another administrator as part of that team come and sit in on those interviews. And again, they're all JPS employees. They're not outside people. They're patient care techs. They are someone who works in our nutritional services or a phlebotomist. And so it really is a great opportunity for them to continue their education here at JPS and completely paid for.
I mean, are we talking UTA or TCU? They could
Anywhere.
Wow, that's very generous.
Anywhere. I mean, you typically see many of our employees are, trying to go through the ADN route because they are working full-time as well. We do have to negotiate because they do have to be an employee. That's part of the requirements of the scholarship, not JPS, but they're a JPS employee. And so they have to maintain hours. And so we do have to work with them on their schedules and things like that. And that's part of the commitment that we make here at JPS is to work with them to help them be successful in school. And so typically you see mostly ADN, students, but you see BSN programs. She mentioned some people are going back to get a second degree, so maybe they got a degree in, something else, and they're now working at JPS in another capacity and wanting to go back to nursing school.
Very generous.
Yeah, we've had people that are physicians in other countries. I can think of like the last group that I interviewed a little bit ago. Physician in another country, came back, works as a tech, and now going back to nursing school because of some complications with, getting their MD here. I can think of phlebotomists, lactation consultants. She mentioned someone working as a tech, a behavioral health tech. We see a lot of our techs. That's typically the higher amount of students is from the tech world, but they're all over our campus, all over our network. It's a great program.
And oftentimes they have extenuating circumstances. They may be the only provider for their families. They may, so that's why I say it's a tearjerker. Yeah.
It's a great help.
And they stay here after they get their
Yes.
Yeah, very committed
RN.
workforce for us. Yeah, they usually have a history to JPS, even some of themselves. They were born at JPS.
Parents have been JPS
Yeah, or they
employees.
have parents that are employed here at JPS as well. So there's a lot of connection to the community with that particular group of students for us.
That's great.
When you're rounding, you know who those nurses are. When you're rounding, you know who those nurses are. They are champions of JPS.
Yeah.
That's
Based on the investment.
Yeah.
The other question, and you've explained this, but could you explain it again? The nurse staffing committee submissions slide, what is that referring to? What are those?
So that's referring to, in those particular areas, if they had a staffing concern or felt like staffing in some way affected patient care, then they send those submissions up to the committee, and then the committee turns and creates action plans against it to say, okay, well, what happened? So we treat it like we do everything, inquisitive questioning, what happened, how many techs were on the floor, how many nurses were on the floor, did we have adequate staffing that day? And then we validate whether we did or we didn't. So we'll find whether or not some of those nursing indicators were causal in our staffing pattern or plan. Maybe 3 people called off that day and we were only able to supply 2 more. And then we had 3 sitter cases and a patient may have fallen. Then they turn around and submit that openly to the committee, and then we go back and tear it apart to make sure that staffing was not causal in an injury or what was going on, and be able to come back and say, what could we have done differently? How could we have staffed better? Could we have pulled somewhere else to that area because we had indicators that told us we were at a high-risk area? So
And there's not many submissions, so it doesn't happen often. Who is allowed to make a submission? Anybody?
Yes.
Any nurse.
Any
Any
nurse can
nurse,
make a submission?
absolutely.
So the fewer, the better.
Yes, in that slide, absolutely. And that's the indicator to the hours per patient day that I was referencing that Jill and Dr. Duncan support, because the higher that number on that slide, higher FTEs, the less falls, the less incidents, and the less incidents of HAPIs and CAUTIs, CLAPSIs, falls, all the other things that I haven't even named.
And if somebody does make a submission, there's no reprisals or?
No retaliation. No, they're making us better. They're making us exceptional.
Yeah, and I know Dr. Davis and Dr. Fowler and Dr. Casey, you can remember during COVID when nurses were leaving here to go travel and we had staffing shortages and nurse concern about safety on the floors, that there were quite a few, Jill can speak about what we would get. I would get personally calls, but there were a number of submissions around just staffing. So it really does, it's almost like stop the line, right? We don't have enough nurses to really provide safe care, and gives them a voice and also informs us and keeps us from having an unsafe environment, so.
Thank you.
You're welcome.
Two questions. One is, and I may not be using the right term, but I visited a member in the hospital, not JPS, and there was a gentleman sitting in the room, and he said he was a sitter. We have those?
Yeah, we do.
We do.
Yeah, we do. So for various reasons, sometimes patients may want to escape. They're an elopement risk. We have other behavioral health needs. They may be pulling on lines or doing things to themselves that we need to keep an eye on them. So yes, that is a common thing across healthcare and at JPS. Yes.
Okay.
We have criteria.
Yep, thank
I
you.
learned something new when I saw that. Okay. The other thing is, pre-COVID, we used to have the nurse recognition program.
I got this.
And it disappeared.
We still have it.
No,
We
you
do it
don't.
differently.
No, you don't.
We do it differently.
I know.
I know what you're referring to.
It was just so outstanding when it was done. I know this room would be packed, but it was good for board members, I know, to just see those nurses and get those awards.
It's a gold stethoscope award.
Yeah, Nurse of the Year. Yeah.
We still have it. We still have it. And we usually do that honor during Nurses Week, so I will make sure you have an invitation.
Please,
Absolutely.
please. I mean, it was really awesome, really awesome. Yeah.
I do have one more question. You just said that the reporting to the committee is done by nurses. Is that the same or duplicative of the other reporting that's done when there's an incident, incident reporting in the hospital?
It's specific to nurse staffing.
Yes.
Specific.
Yeah.
Yes.
I mean, if you submitted through the MIDAS system, it still would make its way to the nurse staffing committee.
Okay.
Yeah.
So you can MIDAS and it will.
Yep.
It would still end
We
up
would
the
still
same
get it,
place.
Either
Yeah.
avenue. Yep.
Yeah.
Perfect.
Thank you, Phyllis. We need a motion and approval.
Move approval.
Got a motion and a second? All in favor? Aye. Okay, great. Not that I'm keeping score, but Zelia wins today on the contracts because she was the only one that's a plus. Everybody else is a minus, so I'm just letting you know.
Is pay for
Understand that all of these contracts allow us to generate revenue.
Oh, that's right, okay.
We don't have operations going, so I want to give everyone credit.
Oh, gosh. Well, thank y'all. Okay, consent agenda. Everybody can see that there. I don't guess I need to read it. It's not very long. AIP was done previously, so it's just item B for human resources and A and B for governance. If there's any questions or comments, we'll ask for a motion. Got a motion and a second. Any discussion? All in favor? Aye. Any opposed? Okay, motion passes. Great. We're going to We're going to take a little break before we convene an executive session. Lunch is served across the hall. We'll take 15, 20 minutes, get settled, grab something to eat. We'll do kind of a little bit of a working thing here while we do executive session, but we got some time. And then dinner served at 5, so so we'll stand adjourned for 15, 20 minutes. We'll reconvene back into open session at 2:22. We've got one item as a result of executive session, and I'll ask for a motion.
I move that we approve the recommendation of the CEO's annual incentive payment for 2024.
Okay, got a motion and a second?
Mr. Chairman?
I will consult with legal.
We discussed the comp amount in close as is permitted under the Open Meetings Act. And the recommendation is that whether or not you're going to approve to pay that out or not.
Okay.
Okay, I've got a motion and a second. All in favor?
Aye.
Any opposed?
Nay.
Okay, motion passes. Thank you. To everyone here, happy holidays and Merry Christmas. The party's tomorrow evening, Mira Vista, 5:30. Be there, be square, and I hope everyone has a happy and safe New Year. Thank you all very much.